Welcome to the EA Tax Training Comprehensive Review of the Tax Provisions of the One Big Beautiful Bill Act of 2025. My name is Tom Norton, and I will be leading you through this new tax law. One housekeeping note: if you would like a free copy of the slides used in this video, there is a link in the description below this video where you can have a PDF copy of the slides sent to your email. When looking below the video on YouTube, you may have to click on the word more in order to see the full description. But once you do, you'll see a link there where you can have the slides sent to your email. What we will cover in today's video is a quick overview of the OBBBA. Then we will look at the individual tax provisions and then the business tax provisions. Now, there are some provisions that straddle the line between individual and business tax, so I just put them where they seem to make the most sense. But in any case, they will all be covered. Also, while this review will be quite comprehensive and it's going to go into more detail than you may have seen from others, I will not be going into every nook and cranny of every provision. A lot of the things in the law are more procedural and administrative than substantive, and frankly, it's not very interesting. So we will be sticking with the main parts of the law that people are actually likely to be interested in. You can then dig into all the nitty-gritty details as necessary. That said, let's start with an overview of the new law. The One Big Beautiful Bill Act, as it was known, was signed into law by President Trump on July 4th, 2025. It is officially Public Law 119-21. It has tax and non-tax provisions, so it is a big bill. I am only going to cover the tax provisions because that's what I know, and presumably that's what you are here to learn about. But know that the law does have a lot of non-tax provisions as well, but we're only going to cover the tax ones. Some of the provisions are effective in 2025 or even earlier in some cases. Many of them are not effective until 2026. And then you've got some that are not effective until 2027 or even dates in the future, further in the future than that. Some of the dates, especially in 2025 or 26, are very specific. So it's not always just January 1st of the year. It can be a specific date within 2025 or within 2026. So what you'll see as we go through here is I have specified for each provision when it is effective. One important note is that none of this applies to the 2025 enrolled agent exam. So my YouTube channel is known for my free course that teaches people to sit for and pass the EA exam, which is officially known as the Special Enrollment Examination, or SEE. So the 2025 exam, which is actually given through February 28th of 2026, covers the 2024 tax law, and it covers that law as it was written and interpreted as of December 31st of 2024. So even though there's a couple of provisions of this new law that apply to 2024 or even before that, they will not be tested on the 2025 exam. The 2025 exam, they already started testing in May of 2025 before this bill was even passed, and they're not changing the test now. So the exam for 2025 given through February 28, 2026 will not test any of the provisions of this new tax law. Now, when we get to next year's exam, which they will start giving in May of 2026, then the 2025 provisions of the One Big Beautiful Bill Act will be tested. However, you're going to see as we go through these slides, a lot of these provisions are not effective until 2026. So those provisions won't be tested until the 2027 exam, because again, you're always looking at the previous tax year that's being tested on the EA exam, but I'm getting ahead of myself. The main thing to know is that for the 2025 exam, you don't have to worry about this. Also, the IRS is going to need to issue guidance on how much of this law is implemented. So Congress writes the law, but then they leave it up to the IRS to administer it and to tell us how to actually implement all of the things that are in the law. We have not seen that yet. We don't know what that is going to look like. So it is possible that the IRS will come out and they will say some things that are a little bit different than what I tell you today, simply because how they have decided to implement the law. We don't know that yet. We're just going to have to wait and see what they say. So you are going to want to stay tuned to keep abreast of all of those changes. Before we talk about the new law in detail, we do need to talk about the previous law, especially the TCJA, which is the Tax Cuts and Jobs Act of 2017. It was effective mostly as of January 1st of 2018. And what it did is it set up a lot of temporary provisions that were effective mostly between 2018 through 2025. And then those provisions, those temporary ones, were set to expire after 2025. So in the tax world, we have known since 2017, 2018, that there was going to need to be a pretty big tax bill sometime in 2025 in order to address all of these expiring provisions. And now here we are with the new tax law. So what the OBBBA does is it extends and modifies many of those provisions that were just temporary in the previous law, in the TCJA. It also eliminates some of the provisions of the TCJA, and it lets others expire by just not addressing them. So on the slides, I'm going to show you what the old law was, and then I'll show you what the new law is. When I say the old law, I am referring to the TCJA and sometimes even the law previous to the TCJA. And then, of course, when I refer to the new law, then I am talking about the OBBBA. So without further ado, let's start looking at the individual tax provisions of the new law. First, the income tax rates from the TCJA are being made permanent. So the current rates are set to expire after 2025 and then revert to their previous higher tax rates. So the TCJA lowered the tax rates and changed the tax brackets, but it only did so through 2025. So the new law makes those tax rate reductions permanent. So the individual tax rates will be permanently, of course, when I say permanent, that means until Congress changes the law again and changes these rates someday in the future, which inevitably they will. But until that time, these are now going to be the income tax rates. There is no date that they are set to expire. So it's the same rates we've been dealing with for the last 7 or 8 years. 10%, 12%, 22, 24, 32, 35, and 37%. For trusts, those rates are 10%, 24, 35, and 37. The TCJA did not change the capital gains tax rates, and so those will remain what they've been for years, 0%, 15%, and 20%. The new law did make the expanded income ranges permanent. So the tax bracket income ranges were expanded by the TCJA. The new law makes those permanent, and it keeps the inflation adjustments. So we've been seeing the inflation adjustments. The new law actually changes a little bit how those inflation adjustments are done, and that is common throughout the new law. It keeps inflation adjustments, but changes the base year that's used. So the exact calculation, how those inflation adjustments are done. But we are used to those brackets changing each year with inflation, and that same sort of scheme will continue to happen. The higher standard deduction is also made permanent. The standard deductions that we have seen since 2018 are much higher than they had historically been before the TCJA. But those higher standard deductions were set to expire after 2025, and so therefore they would then revert to their previous lower amounts. But the new law makes those increased, larger standard deductions permanent with inflation adjustments, and it also set what the 2025 standard deduction amounts are. So those are shown on your screen. For married filing joint and qualifying surviving spouse, it's $31,500. For single or married filing separately, it's half of the married filing joint amount, so it's $15,750. And for head of household, it's right in between those two. It is $23,625. Personal exemptions. Prior to 2018, there were personal exemptions that everybody got. The TCJA temporarily suspended those personal exemptions. So what would happen is everyone on the tax return, meaning if you're single, it'd just be you'd get a personal exemption for yourself. If you're married, filing jointly, you and your spouse would each get a personal exemption. If you had any dependents, then each dependent, you would get a personal exemption for them. And a personal exemption was just an extra deduction that you got for each person on the tax return. So that's the scheme that we had prior to 2018. So you had a lower standard deduction, but then you got a personal exemption for each person on the tax return. What the TCJA did starting in 2018 was it took away that personal exemption, but it increased the standard deduction. But again, all of that was just temporary through 2025. So what the new law does is, as we've already seen, it keeps the higher standard deduction, but it is also making permanent the elimination of those personal exemptions. So we are not going to have the personal exemptions, except for one thing that they did add. Congress added in this new law a temporary exemption for seniors. So you may remember when this law was being debated, many people, including the president, wanted to end the income tax on Social Security. You might remember that's one of the things that he was saying out on the campaign trail, is that we're going to eliminate income tax on Social Security. Well, for a lot of reasons, political reasons and legal reasons, they were not able to actually say that your Social Security is not taxable. They couldn't do that. So what they did instead is they put in this exemption for seniors. Now, it's not tied to receiving Social Security. So some people are under age 65, but they receive Social Security, but they are not going to get this exemption. Other people are age 65, but they don't receive Social Security. They will get this exemption. What it is a $6,000 exemption per person who is age 65 or older. So if you're a married couple, you're both age 65 or older, then you will get double the exemption. You'll get $12,000 exemption instead of $6,000. Now, this $6,000 amount is not adjusted for inflation, and it does get reduced for higher income taxpayers. So it is reduced by 6% of your modified adjusted gross income that exceeds $75,000, or if you are married filing jointly, $150,000. In order to get this exemption, you must have a Social Security number and you must put it on the tax return. And it is only set right now for tax years 2025 through 2028. So unless Congress acts before then, this will expire after the 2028 tax year. And again, all this is an extra deduction for people who are age 65 or older, and it is called an exemption. Next up is the child tax credit. So the TCJA increased the child tax credit to $2,000, of which $1,400 is refundable. That increase was set to expire after 2025 and revert to the previous amount of $1,000 per child under age 17 with no inflation adjustments. So what the new law did is it made that increased child tax credit permanent, and it actually enhanced it. It increased it even more. So the credit for 2025 is now $2,200, and the refundable portion is $1,700. They do that through something they call the additional child tax credit, but all that does is make $1,700 of the $2,200 refundable, and then that $2,200 amount and the $1,700 amount will be indexed for inflation. You must provide the Social Security number for the taxpayer and the child. So they have to have a Social Security number, and you have to put it on the tax return in order to take the credit. And as there was before, there is a phase out for people who have higher incomes. So if your modified adjusted gross income is greater than $400,000 if you're married filing jointly, or greater than $200,000 for all other filing statuses, then this child tax credit will start to phase out, and the more income you make, eventually it all goes away and you don't get any child tax credit. As we talk about modified adjusted gross income, or MAGI, as we go through this, in general, what that means is normal adjusted gross income, but you have to add back any income that was excluded due to the foreign earned income exclusion or some exclusions for income from Puerto Rico. So that in general, that's what we mean by modified adjusted gross income. So for most taxpayers, modified adjusted gross income is just going to be adjusted gross income. Along with the child tax credit, there's also something called the credit for other dependents, or the ODC, other dependents credit. That $500 credit is set to expire after 2025 with the old law. So the new law makes that permanent. It is still $500. It is not indexed for inflation. And again, you have to have a Social Security number. And again, it phases out with the same adjusted gross income levels that we talked about for the child tax credit. Next is the estate and gift tax exemption. So under the old law, you have an increased estate and gift tax exemption. So in 2017, it used to be just $5 million. The new law starting in 2018 increased that significantly and indexed it to inflation. So it was set to be, for 2025, $13,990,000. So what the new law does is it makes the increased amount permanent, and it makes the 2026 amount $15 million. So the 2025 amount will still be $13,990,000. The 2026 amount will go to a flat $15 million, and then it will be indexed for inflation from there. The alternative minimum tax. So the current AMT exemptions and phase-out ranges are set to expire after 2025, and then they will revert to their previous lower amounts. So before 2018, more people were likely to have to owe the alternative minimum tax than after 2018, because the TCJA increased the exemptions and the phase-out ranges. But those increased amounts were set to expire after 2025. So what the new law does is it makes those permanent. So the increases are permanent and they are indexed for inflation. So the 2025 amounts are not changing from what they were supposed to be. But for starting in 2026, they will be indexed for inflation based on the 2025 amount. So that's kind of the good news, but it's not all good news when it comes to the AMT, because a couple of things actually make more people have to pay the AMT or to have to pay more of it. So the exemption phase out threshold is going to revert to alternative minimum taxable income amounts of $500,000 for all taxpayers who are not married filing jointly, and $1 million for taxpayers who are married filing jointly starting in 2026, and then they will be indexed for inflation. So for comparison purposes, the 2025 amounts are $626,350 if you're not married filing jointly, and $1,252,700 if you are married filing jointly. So what these are is, if your AMTI is above a certain amount, then your AMT exemptions start to phase out. And so you are going to have to pay more alternative minimum tax than you would if your income was lower. So what they are doing is actually lowering those thresholds, so more people will now have to pay more AMT due to the lower thresholds. Also, the exemption phase out percentage is increasing. So it used to be, under the old law, that the AMT exemptions were decreased by 25 cents for every dollar of income over the threshold amount. Now those exemptions will be decreased by 50 cents for every dollar over those threshold amounts. So what they're doing with this law is they're keeping the higher exemptions so that middle class taxpayers are not as likely to have to pay the alternative minimum tax. But they are making it more likely that higher income taxpayers will have to pay the alternative minimum tax, which, to be fair, was the whole reason the AMT was put into place in the first place, was to make sure that higher income individuals had to pay at least some income tax. Qualified residence interest. So the old law says that interest on home loans is deductible as an itemized deduction with certain limitations. The maximum home acquisition indebtedness for deductible interest is currently $750,000 through 2025. Starting in 2026, that limit was going to revert to its previous amount, which was actually higher. It was $1 million, and home equity debt would be limited to $100,000. So the way the law is now, so from 2018 through 2025, the maximum indebtedness you could have was $750,000. But as long as you met all the requirements, that could be both a first mortgage, it could be a home equity loan, it didn't matter. As long as the total was under that $750,000, you could deduct all of the interest. And the loans did have to be what's called home acquisition indebtedness. So it had to be money actually borrowed to buy the home or to improve the home. It couldn't be from a cash out refinancing that you got, for instance. But as long as you did have legitimate home acquisition indebtedness, as long as the total was not more than that $750,000, then you could deduct all of it. If the law had not changed starting next year in 2026, the $750,000 would have gone up to $1 million. However, the home equity portion would have been limited to $100,000. So what the new law did is it kept the $750,000 limit. However, it does not allow any interest on any home equity debt. So the interest on home equity loans will no longer be deductible. It will only be a first mortgage that qualifies as home acquisition debt up to that $750,000. Only the interest on that amount will be deductible. So that's a little bit of bad news. There is some good news, though. Starting in 2026, mortgage insurance premiums will be deductible as interest. So those were previously not deductible, but now they will be. However, that deduction will phase out as AGI gets over $100,000 or $50,000 if you are married filing separately. So again, that's going to help kind of those middle class taxpayers who are the ones who are more likely to have to pay mortgage insurance premiums. It's going to give them that extra deduction. Casualty losses. So for 2018 through 2025, personal casualty and theft losses are deductible only if they are attributable to a federally declared disaster area. So what you do is, as a reminder, you deduct $100 from each casualty, and then the aggregate loss is deductible to the extent it exceeds 10% of your adjusted gross income. Starting in 2026, it would have reverted to the previous rule, which was calculated the same, except the casualty or theft did not have to be in a disaster area. You could have a casualty or theft just in the course of your everyday life, and you could deduct it. You still had to deduct $100 from each casualty, and then you could only deduct them to the extent they exceeded 10% of adjusted gross income, but they did not have to occur in a federal disaster area. So what the new law does is it makes the disaster area requirement permanent. So in order to deduct a casualty or theft loss, it will have to be in a disaster area. Now, it did expand the definition to include both federal and state declared disasters. So the way it's been since 2018 is it had to be a federally declared disaster. Now, going forward, it can be a federally declared disaster, or if the individual state declares a disaster, that will count as well. And state here includes all of the 50 states, of course, but it also includes the District of Columbia, Puerto Rico, and the Virgin Islands, Guam, American Samoa, and the Northern Mariana Islands. Sticking with the casualty loss theme here, non-itemizers can also sometimes take a personal casualty loss deduction. So the current law, or the old law, says that if you don't itemize and you have a casualty loss, again, in a federally declared disaster area, then you can subtract $500 from that casualty, and the remaining loss, the rest of the remaining loss, can be added to the standard deduction. So it gives you an increased standard deduction for that year. And that applies to disasters that occurred by December 12th of 2024 that must have ended, the disaster must have ended by January 11th of 2025. So what Congress has been doing is each year they're kind of changing the goalposts on the dates for these disasters. So what the new law does is it extends the goalposts again. So it says that you can still take this extra standard deduction for federally declared disasters that occurred through July 4th of 2025 when the law was enacted, as long as they ended by August 3rd of 2025. And so it's likely that in the future, Congress will again extend these dates. But for now, this is what the law says. The disaster had to occur and be declared by July 4th of 2025. Note here, it does still have to be a federally declared disaster if you are a non-itemizer. Miscellaneous itemized deductions. Prior to 2018, there was a deduction for something called miscellaneous itemized deductions. These were called the 2% itemized deductions because what you did is you added them all up, and to the extent the aggregate of all of them exceeded 2% of your adjusted gross income, you had a deduction. So these deductions included unreimbursed expenses as an employee, investment expenses, tax preparation fees, and there were others that were included in there. For 2018 through 2025, those were disallowed, but they were set to return starting again in 2026. So what the new law does is it permanently removes those 2% miscellaneous itemized deductions. However, it does add a new miscellaneous itemized deduction for educator expenses. So this will start in 2026. So these are the same type of expenses that are allowed for educators as an above the line deduction. You're probably familiar with that. But with the itemized deductions, there is no annual limit. So for the above the line deduction, you get $300 per educator of these expenses. The below the line deduction that is now going to be allowed, the itemized deduction, there is no $300 limit. There is no limit on those deductions. The above the line deduction is still available with the same limit. So that has not changed. This is just now adding an itemized deduction. There's nothing in the law that says you cannot take both. So I have there on the screen, can you take both? I assume that you can because there's nothing that says that you cannot. However, I'm going to watch and see what the IRS says in case they want to put a rule in there or try to put a rule in there that says you can't take both. I don't suspect they will do that because the law doesn't say that, but I am interested to see what they say. Now, one thing is for sure, you're not going to be able to use the same expenses for the above the line deduction and the below the line deduction. That's definite. But it may be if you've got more than $300 that you could take $300 as an above the line deduction and then take the remaining amount as an itemized deduction. So that's what I believe is going to happen. We will see how this actually gets implemented by the IRS. Limitation on itemized deductions. Prior to 2018, there was a limitation on the overall itemized deductions that you were allowed to take for higher income taxpayers. This was called the PEAS limitation. This limitation, though, was suspended for the years 2018 through 2025, but it's scheduled to come back under the old law starting in 2026. So it was a gradual reduction as your income increased. It got over certain threshold amounts. You had to reduce your overall itemized deductions, and it could actually eliminate as much as 80% of the itemized deductions of high income taxpayers. So you could only have 20% potentially of your total itemized deductions that you are actually allowed to take. Well, that particular limitation is being repealed with this new law, and it is being replaced with a new limitation that will be effective in 2026. What is that new limitation, you ask? Well, I'm glad you asked. So effective in 2026, itemized deductions will begin to be phased out once taxable income reaches the 37% tax bracket. So remember, 37% bracket is the highest tax bracket. So once you reach the bottom number, taxable income number, of that 37% tax bracket, of course, that bottom number is going to change every year with inflation. But once you reach that bottom number and you get over that bottom number, your total itemized deductions are going to start to phase out. The phase out amount is 2/37 of the lesser of your total itemized deductions, or the amount that your taxable income exceeds the beginning of the 37% tax bracket. And we're going to look at an example here in a minute so you can see how this works. The phase out amount is calculated after any other limitations are imposed, such as the state and local tax limitation, the limitation on medical expenses, etc. So several of the expenses, there's already limitations. Well, you have to do those limitations first, figure out, okay, what are my total itemized deductions that I'm allowed to deduct? Then you apply this further limitation. If you are taking the qualified business income deduction, which we'll be talking about a little bit later in the business section, you do not have to include this phase-out amount for purposes of calculating the QBID. So the QBID can be limited based on your taxable income. But when you are figuring out your taxable income for purposes of the QBID, you do not have to include this phase-out of the itemized deductions. So let's look at an example of how this phase out works. In 2026, Dennis's taxable income is $80,000 above the beginning of the 37% tax bracket. His total itemized deductions are $60,000. So his itemized deductions must be reduced by the lesser of 2/37 of $60,000, which is $3,243, or 2/37 of $80,000, which is the amount that his income exceeds the beginning of the 37% tax bracket. That amount is calculated as $4,324. Therefore, his deductible itemized deductions are $60,000 minus $3,243 because it is the lesser of these two. So $60,000 minus the $3,243. His itemized deductions on his tax return will now be $56,757. Now, of course, when you're actually doing this for your clients, you don't have to compute both of these amounts because you're going to take 2/37 of the smaller. So once you know that, oh, okay, my itemized deductions are lower than the amount my income exceeds the lowest part of the 37% tax bracket, you know that it's going to be the $60,000 that you multiply it by, and so you just do that calculation. But I wanted to show you both calculations just so you can see how it works. Moving expenses. Prior to 2018, moving expenses were deductible for any taxpayer if they were moving for their job or for their own business, as long as you met certain distance requirements that were in the law. For 2018 through 2025, that deduction was disallowed for everyone except for active duty military who were moving pursuant to a military order. They are still allowed to deduct their moving expenses, and there's no distance requirements or anything like that. And they deduct that. It's an adjustment to income, so they don't have to itemize in order to deduct that. But starting in 2026, we were supposed to go back to the pre-2018 rules that would have allowed anyone to do it as long as they met all of those requirements. Well, the new law makes that armed forces only rule permanent. So only the members of the armed forces can do it. You don't have any of the distance requirements in order to meet the test, in order to be able to deduct it. But it does add some people to the armed forces definition. So it also includes now members of the intelligence community. So it could be the CIA, the NSA, organizations like that. And for all of that, that is effective starting in 2026. Gambling loss limitations. So the old law said that gambling losses are deductible, but only to the extent of gambling winnings. For non-professional gamblers, you could only deduct your gambling losses if you itemized your deductions. So if you're not a professional gambler, let's say you hit a slot machine for $10,000. You have to include that $10,000 in your income. Now, if throughout the year you had lost money on slot machines, so let's say you had lost $6,000 gambling, you can only deduct that $6,000 if you itemize deductions. So you'd have to add your $6,000 gambling loss to all of your other itemized deductions, if you end up not having more than the standard deduction, you could not deduct that $6,000 of gambling losses. So you have to include the entire $10,000 in income, and you cannot deduct the $6,000 of gambling losses. That's for non-professionals. For professional gamblers, for 2018 through 2025, gambling losses included gambling expenses such as travel, hotels, etc. But the total of your actual gambling losses and those related expenses cannot exceed your gambling income. So in other words, you can't show a business loss. So if you're a professional gambler, you would do a Schedule C on your tax return, and you're going to show all of your income from gambling and all of your losses from gambling and all of your expenses from gambling. But your losses and your expenses were not allowed to be more than your gambling income. So 0 was the best you could do. You could not have a business loss from your gambling activities. But that provision was set to expire after 2025. So here's what the new law did. Starting in 2026, gambling losses are limited to 90% of gambling winnings. And this is for everyone, whether you're a professional or not. So if you are not a professional gambler and you win $10,000 on a slot machine, and throughout the rest of the year, you lose $10,000 on slot machines, so you broke even for the year, you're going to have to report the entire $10,000 as income. And then if you itemize deductions, you can only deduct $9,000 of those gambling losses. And again, if you don't itemize, you can't deduct any of the gambling losses. But even if you do itemize, you can only deduct up to 90% of the amount of your winnings as a gambling loss. For professional gamblers, they can still include their expenses, travel, hotels, etc. However, they've still got the same 90% limitation. So when they add up all of their actual gambling losses and all of their expenses, when they deduct those, they can only deduct them to the extent they have 90% of their winnings. So let's say you've got a professional poker player, for instance, who is traveling around the country playing in poker tournaments, and during the year they win $100,000 in poker tournaments, but they lose $80,000 by entering tournaments that they didn't win. So they've got $100,000 in wins, they've got $80,000 in losses, but they've also got expenses for traveling, for their hotels, for meals, all of that. Let's say their expenses are $30,000. So they've got $100,000 of income. They've got $110,000 of losses and expenses. Under the old rule, they would be at 0. They would have no income. They would have no loss, because even though they had $10,000 of excess loss, they're not allowed to take it. So it would have been 0. Under the new rule, they can only deduct up to $90,000 of losses and expenses. So even though they lost $10,000 for the year, they would actually have to pay tax on $10,000 of income. They would show on Schedule C $100,000 of revenue and $90,000 of expenses, and they would have a $10,000 gain for the year. There are already people lobbying to get this changed because it kind of seems unfair, especially for the professional gamblers, but even for the non-professional gamblers, it doesn't seem fair. So there are people trying to get that changed by the end of the year before 2026 gets here. We will see whether or not that happens. But for now, this is what the law says. ABLE accounts. So there are these accounts, Achieving a Better Life Experience, or ABLE accounts, that are tax-favored accounts for disabled individuals. So for 2018 through 2025, if there were amounts in a 529 plan, which is a qualified tuition program plan, with a beneficiary who is now disabled and has an ABLE account, you are allowed to roll the money from the 529 plan into the ABLE account as long as you met certain requirements. So let's say you had a little baby and the parents, the grandparents started this 529 plan for their future college education. And then it turns out at some point along the way, that child becomes disabled, or it's discovered that they are disabled and they're not able to go to college or to any type of schooling past high school, and may not even be able to go to high school, depending on the circumstances. Well, what you could do is take the money from that education account and roll it into this ABLE account. And then the amounts that are in that ABLE account can be used to help support that disabled individual. What the law also said for 2018 through 2025 is that the beneficiary themselves, so the disabled person themselves, could make additional contributions to their own account in excess of the normal limitations. So there are limitations to how much can be contributed to an ABLE account every year. So it might be, again, parents, grandparents who are contributing to this account, but there are limitations on how much can be contributed. But what the law has said is that the individual themselves, if they're able to go out and work and earn money, they can contribute to their own ABLE account, and then that money grows tax-free until they need it. And the amount that they contribute will not count against that annual contribution limit. And the person can actually take the saver's credit for the amount of those contributions. And we'll be talking about the saver's credit here next. But that's what the law said for 2018 through 2025, but that was set to expire. So what the new law does is it makes those rules permanent. So from here on out, you can roll amounts from a 529 plan into an ABLE account without tax consequences, and the beneficiary can make contributions to their own ABLE account without affecting the normal contribution limits. The saver's credit, what this does is it allows lower income taxpayers to receive a credit for contributing to a retirement account. It could be an IRA, could be an employer-sponsored plan, or it could be an ABLE account, as we just discussed. They can get a credit for up to $2,000 of contributions. So the amount of the credit ranges from 10% of their contribution up to 50% of their contribution, depending on how much money they make. So the credit is a percentage of their contribution with a maximum contribution amount of $2,000. So for instance, if they get a 50% saver's credit, if they contribute a full $2,000 to the retirement account, they get a $1,000 credit. If they are in the 10% income bracket, they contribute $2,000, they get a $200 credit. Congress passed a different law. So this was not the TCJA. They passed a different law called the Secure 2.0 Act in December of 2022. What that did was it changed how this worked. It was going to eliminate the saver's credit, so there would be no more saver's credit. And it was going to replace it with a government contribution straight to the taxpayer's retirement plan. So they were going to say, instead of giving you a credit on your taxes, we are just going to put money into your retirement plan on your behalf as long as you meet these income requirements and you contribute yourself to your retirement plan. So what the OBBBA does is it repeals that Secure 2.0 Act provisions regarding the saver's credit. And it makes the old saver's credit permanent. So we're not going to have direct government contributions to the taxpayers' retirement plans. We are still going to have the saver's credit. And then starting in 2027, the amount of the contribution that will be eligible is increased to $2,100. So for 2025, 2026, it will still be a $2,000 contribution that you can take the credit for. Starting in 2027, it will be a $2,100 contribution, and that amount is not indexed for inflation. Sinai Peninsula. So a qualified hazardous duty zone is treated like a combat zone for members of the U.S. Armed Forces, and that gives them certain tax benefits. The Sinai Peninsula of Egypt counts as one of those hazardous duty zones, but only through 2025 under the old law. What the new law does is it makes that permanent. So the Sinai Peninsula of Egypt will permanently be considered a hazardous duty zone, and it actually adds some other areas that will be permanently considered hazardous duty zones. Those are Kenya, Mali, Burkina Faso, and Chad. So all of those areas and the Sinai Peninsula are hazardous duty zones effective January 1st of 2026. Discharged student loans. So in general, discharge of indebtedness is taxable income with some exceptions. For 2021 through 2025, the discharge of a student loan is not taxable income as long as the student is not required to work for the lender in exchange. So this was put into place during COVID to give people a break. If their student loan was discharged, it would not be included in taxable income, but that's only through 2025. So the new law is allowing that 2025 date to come and go and allowing that law to go away. It's allowing it to sunset. Sunset meaning it's just going to run its natural course and then it is going to go away. It is going to expire. So effective January 1st, 2026, discharge of a student loan will be included in income. However, they did put in this one provision that says if the student dies or is totally disabled, then it will not be included in their income. But unless the student dies or is totally disabled, if you have a discharge of a student loan, it will be included in income just like any other discharge of debt is included in income. And also the Social Security number has to be on the return if you're going to take advantage of this exclusion for death or disability. State and local tax deduction. State and local taxes, or SALT, are deductible. Prior to 2018, they were deductible in full. There were no limitations. Starting in 2018 through 2025, the total SALT deduction is limited to $10,000. So this has caused a huge change in the tax world. You've now had states actually enact laws to help residents of their states get around this limitation, at least residents who own businesses. There's something called the PTET rules, which is the pass-through entity tax rules. If you have a S corporation or you have a partnership, normally those entities do not pay income taxes. Instead, the shareholders or the partners pay the income taxes. But they've actually changed the law in many states throughout the United States that allows those entities, those partnerships and those S corps, to pay the tax at the entity level, which effectively gets around this $10,000 limitation, at least for those who own businesses. So this $10,000 limit has really caused a chain reaction that has significantly affected how we as tax preparers prepare income tax returns and how taxpayers pay their income taxes. But that limit was set to expire after 2025, which means it would have gone back to the old rules, which are that there is no limit. So what the new law does is it makes the limited SALT deduction permanent. However, it changes the amount. So you can see there on your screen, it's going up. For 2025, instead of $10,000 as the SALT limit, it is now $40,000. And then you can see each year through 2029, that amount is increased a little bit each year. And the way the law is written now, starting in 2030, it'll go back to $10,000. But of course, what the current Congress is doing is assuming that in 2029, the Congress at that time will be able to do something about this, and they can extend it again or change it again if they would like to do that. But for the years, the tax years, 2025 through 2029, these are the SALT limitations. Now, if you are married filing separately, then it is half of these amounts. But for all of the other filing statuses, it's $40,000 for 2025 and then goes up a little bit each year through 2029. Also through 2029, it is possible to have that SALT limitation reduced for higher income taxpayers. So that limitation, so for instance, the 2025 limitation of $40,000, that will be reduced by 30% of modified adjusted gross income over these threshold amounts. So the threshold amount for 2025 is $500,000. So if you have modified adjusted gross income of greater than $500,000 in 2025, then you're going to have to take 30% of the excess over that threshold amount, and you're going to subtract that much from your $40,000 limitation. I'm going to show you an example here in a minute so you can see exactly how this works. But those threshold amounts, again, go up a little bit each year, starts at $500,000 for 2025, and then goes up each year through 2029. And again, if you're married filing separately, your threshold is half of these amounts. No matter how high your income is, though, the limitation cannot be reduced below $10,000. So it starts at $40,000 for 2025, cannot go below $10,000 no matter how much you make. So let's look at an example. In 2025, Delilah has AGI of $550,000 and pays state and local taxes of $60,000. Her SALT deduction is initially limited to $40,000 and must be further reduced by $550,000 that she made minus the $500,000 threshold amount times 30%. So she's $50,000 over the threshold amount. 30% of that is $15,000. Subtract that $15,000 from the $40,000 limitation. Her final state and local tax deduction is $25,000. Example 2. In 2026, Delilah has adjusted gross income of $700,000 and state and local taxes of $70,000. Her $40,400 SALT deduction must be reduced by the excess of the $700,000 over the $505,000 threshold amount. So 30% of that is $58,500. So you take her $40,400, you subtract the $58,500, which of course would give you a negative number. But remember, it cannot be less than $10,000. So therefore, her final SALT deduction for 2026 is $10,000. No tax on tips. And that is how this provision is titled. So it's not exactly no tax on tips. It's actually a deduction, but that's what it's called, no tax on tips. So the old law said that tips received are fully taxable, of course. What the new law says is that for 2025 through 2028, a deduction for qualified tips received and reported on a statement like a W-2 is allowed up to a maximum of $25,000 per year. In order to take this deduction, you do not have to itemize. It's a separate below the line deduction. So it's after adjusted gross income, but it's down there in the same section as the standard deduction and the qualified business income deduction will be this qualified tips deduction. The $25,000 deduction does, though, begin to phase out for higher income taxpayers. So if your adjusted gross income exceeds $150,000 or $300,000 if you're married filing jointly, then you will reduce that $25,000 deduction by $100 for each $1,000 of modified adjusted gross income over the threshold amount. And there is no deduction allowed if you are married filing separately. So if you are married, you have to file jointly in order to get this tips deduction. If you are self-employed, the deduction cannot exceed the profit from your business. So you can't take a deduction greater than the net profit from your business. You can't effectively have a loss from your business due to this deduction. And this is an income tax deduction only. So you're still going to owe Social Security and Medicare tax or self-employment tax if you're self-employed on those tips. So you're going to get your tips. It's going to be reported on your W-2. They're going to withhold Social Security and Medicare tax. They're going to include the full amount of the tips on your W-2. You're going to report those amounts. The full amount of the income from the tips will be reported on page 1 of your 1040, but then you will get a deduction of up to $25,000 below the line in order to deduct that amount of the tips. So what are qualified tips? So the term qualified tips means cash tips received by an individual in an occupation which customarily and regularly received tips on or before December 31st, 2024, as provided by the Secretary. So in other words, the IRS is going to come out with a list of professions that they say customarily and regularly received tips on or before December 31st of 2024. So they'll be coming out with that list sometime in the fall of 2025. That's what they've been directed to do. When they say cash tips, that can be either actual cash, it could be charge, like on a credit card, or it could be through a tip sharing arrangement. The tips must be reported on a W-2 or a 1099 or declared on the Form 4137, which is Social Security and Medicare tax on unreported tip income. So in order to take the deduction, the tips do have to be reported somewhere and included in your income first. Then you can take the deduction. When we get to the business section, we will talk about the employer's responsibilities as far as this reporting goes. In order to be considered a tip, it must have been paid voluntarily, and the amount had to be determined by the payor without any negotiation and without any negative consequences for not paying. So, for example, some restaurants, if you go in there and you have a party of like 6 or more people, they will automatically add on a service charge of like 18%. It's automatically added on to your bill. Well, presumably, that 18% will not qualify for this tip deduction because that is not voluntary. That 18% is simply added on there and you have to pay it. So that would not qualify. So it will be interesting to see, first of all, what the IRS says about that, how they implement it, and secondly, how restaurants react to this. Will they take away that 18% service charge in order to make it voluntary, or will they not do that? So we'll have to see how all of that plays out. Also, any tips that are received in a specified service, trade, or business, or SSTB. So this is a qualified business income deduction concept, but they use the same definition here. If you are in one of those trades, which is accounting, law, health, engineering, medicine, and a few others, any tips you receive fully taxable and you cannot deduct them. If you take a tips deduction and you have qualified business income deduction from that same activity, then you will subtract the deduction from the related business income. So let's say you are a hairstylist, you are self-employed, of course you are receiving tips. When you compute your business income for purposes of the QBID, you will subtract this tips deduction in determining that income. And then for all of these things, the IRS can add other requirements and guidance as they seem fit. And I'm sure that they will do that. And so again, we will see what that looks like. Now we'll move on to a similar concept, which is no tax on overtime. So of course, the old law is that overtime compensation is fully taxable. But again, for the years 2025 through 2028, a deduction for qualified overtime compensation received and reported on a statement, usually it's going to be a W-2, is allowed up to a maximum of $12,500 per year, or $25,000 if you are married filing jointly. And again, you see those years 2025 through 2028. So for both of these provisions, the tips and the overtime, Congress is making it temporary only through 2028. So what they are again doing is allowing the Congress at that time to decide whether or not to continue this or to discontinue it or to modify it as they seem fit. So for right now, it is just for those tax years. What does qualified overtime compensation mean? It is overtime paid to an individual that is required by Section 7 of the Fair Labor Standards Act of 1938 that is in excess of the regular rate at which such individual is employed. And in any case, though, it does not include any qualified tips that will not be included in overtime compensation. In order to take this deduction again, you do not have to itemize. It is a separate below the line deduction, just like the tips deduction is. And it does also phase out for higher income taxpayers, and it's $150,000 unless you are married filing jointly, in which case it is AGI of $300,000. The deduction is reduced by $100 for each $1,000 that the adjusted gross income is over the threshold. Again, there is no deduction allowed for married filing separately. And again, it is an income tax deduction only. Your employer is still going to withhold Social Security and Medicare tax. They're still going to report the full amount of the overtime on your W-2. You are going to include the income on page 1 under wages and salaries, and then you will get the deduction below the line for up to $12,500 or the $25,000 if you are married filing jointly. And again, you have to have a Social Security number, and it has to be on the tax return. No tax on car loan interest. So the old law is that interest on a personal car loan is not deductible. It has not been deductible since 1986. Starting in 2025, and again through 2028, a deduction will be allowed of up to $10,000 for qualified passenger vehicle loan interest. The deduction does phase out for higher income taxpayers. As you can see there, it's for AGI over $100,000 or $200,000 married filing jointly. The deduction is reduced by $200 for each $1,000 of adjusted gross income over the threshold. This is for interest paid or accrued on indebtedness incurred for the purchase of and that is secured by a first lien on an applicable passenger vehicle for personal use. So this must be a new passenger vehicle. Has to have at least 2 wheels, so that could be a motorcycle, and it has to be designed for use on public streets. So we're talking about your typical car, minivan, SUV, pickup truck, or motorcycle. That's what we mean here. The gross vehicle weight rating has to be less than 14,000 pounds, and final assembly has to have been in the United States. So notice here, has to be a new car. Used cars do not count. The lender has to have a lien on the title of the vehicle. It has to be your typical passenger type vehicle, including a motorcycle, and it has to be for personal use. Of course, if you have a vehicle that's for business use, then you may be able to deduct the interest on your business tax return, depending on the circumstances. But for this particular deduction, has to be for personal use. This does include a refinanced loan as long as that loan is not more than the balance of the old loan. So if you get a loan at let's say it's at a high interest rate, and then a couple of years later, you refinance that loan with a new lender or even with the same lender, as long as it meets the requirements, so there's still a lien on the vehicle, and as long as the amount of the new loan was not more than what the old balance was, so you didn't get cash out from the new loan, then you can still deduct that interest. Qualified interest does not include any lease financing, any interest paid to a related party, or interest on vehicles that are not for personal use, fleet sales, vehicles with a salvage title, or those intended to be used for scrap or parts. And you must include the vehicle identification number, or VIN, on the tax return. Trump accounts. So we are going to spend several slides here talking about Trump accounts, and that is what they are actually called. So this is totally new. There was no such thing in the old law. What the new law does is it creates a new tax-deferred IRA, individual retirement account, for children under the age of 18, and they are similar to a traditional IRA. However, contributions to these accounts are not tax deductible. They do grow tax-free or tax-deferred, but the contributions are not tax deductible, and the amounts must be invested in a mutual fund that tracks an established index of U.S. equities and meets other criteria. Basically, it has to be in a low-cost index mutual fund. That's what the law says. Contributions to these accounts are not allowed until July 4th of 2026. The child must be under 18 years of age. They must be a U.S. citizen, and they must have a Social Security number. Contributions are generally limited to $5,000 per year per beneficiary, and that amount will be indexed for inflation. And those contributions must be made by the end of the calendar year. So if you're familiar with a regular IRA, you can make those contributions all the way up until the tax return is due, so April 15th of the following year. But not the case for these Trump accounts. The contributions must be made by the end of the calendar year to which they apply. So if it's 2026, they have to be made by December 31st of 2026. The $5,000 limitation is per beneficiary, not per account. So you can't open multiple accounts and put $5,000 into each account. It's $5,000 per beneficiary. You could still have multiple accounts, but the total contributions per year cannot be more than $5,000. And those are contributions from everyone. So the contributions might be made by parents, grandparents, aunts, uncles, or even the child themselves. But in any case, the total of all of those contributions cannot be more than $5,000 per year. Once the beneficiary turns 18, then the account turns into just a regular traditional IRA account. In addition to the contributions we just talked about, contributions can also be made by tax-exempt entities and governmental units. If they are made, they must be made to a class of individuals who meet certain criteria, such as living in a certain geographic area, such as a state. So, for instance, maybe you'll see some states that decide that they are going to contribute to the accounts for everybody under 18 in their state. They might do that. Or they might do it for everybody under 18 who meet certain income requirements or something like that. So they would be allowed to do that. If they do that, there does have to be at least 5,000 beneficiaries in a class. So they can't target these contributions to specific individuals. You have to have at least 5,000 beneficiaries in the class. And as we said, this might not be a governmental unit, it might be a tax-exempt entity. So certain tax-exempt entities, they might decide that, oh, we're going to contribute to a certain class of individuals, and they're going to set certain criteria, and they'll say, if you meet this criteria, then we will contribute to your account. They can do that as long as they meet all of these criteria that are listed here. Any contributions that are made in this way do not count toward that $5,000 annual contribution limit. So that annual contribution limit, that applies to the contributions that family members are making, etc., does not apply to any of these contributions that are made by governmental or tax-exempt entities. Employer contributions. So in addition to the contributions we've just talked about, employers can also make contributions to these accounts. So they can make it to the account of their employees. If they've got an employee who's under the age of 18, they could make contributions to those accounts. Or probably more frequently, what will happen is employers will make contributions to the accounts of the children of their employees. So the qualified beneficiaries of their employees, they can make contributions to those accounts up to $2,500 that they contribute per year, and that amount is indexed for inflation, will be excluded from the income of the employee and the beneficiary. So this can be, if employers choose to do it, a new kind of perk, a new benefit. They'll say, we will contribute some amount, up to $2,500 per year, to your child, for instance, to their Trump account. And that $2,500 will be excluded from the income of the employee and of the beneficiary. If they do make these contributions, however, they do count toward the $5,000 maximum annual contribution. And in order to do this, it has to be part of a written plan of that employer. Pilot programs. So you probably heard about this when you've heard about this law. So the IRS is doing a pilot program where the government will actually be contributing to and or establishing accounts for newborn children. So this applies to all qualifying children born from January 1st of 2025 through December 31st of 2028. So they're calling it a pilot program. They're going to try it for these, 4 years, 2025, 26, 27, 28. Yes, 4 years. And they're going to see how it goes. And then they will let the Congress in the future decide whether or not to continue it or modify it, etc. But for these 4 years, the government will contribute $1,000 to the account of every qualifying child that is born during those years. An election must be made on your tax return in order to request this contribution. However, if no account is set up on behalf of an eligible child, the IRS can create an account for them and make the $1,000 contribution. We're going to have to wait and see how this is implemented. I am not exactly sure, I don't think anyone is exactly sure how this is going to work. If you don't make the election, but they've got birth records that say that you had a child, Are they then going to go ahead, set up an account on the child's behalf and contribute the $1,000? Or is there going to be some other mechanism? We are just not sure at this point. But the IRS will contribute $1,000 into those accounts. That amount is not taxable, and it does not count toward the $5,000 annual contribution limit. And our final slide on these Trump accounts has to do with distributions. So we've been talking primarily about contributions to these IRAs. What about distributions? Distributions are generally not allowed until the first day of the calendar year that the beneficiary reaches age 18. Now, there are some exceptions for rollovers or for distributions of excess contributions, or in the case of the death of the beneficiary. But the general rule is no distributions until the first day of the calendar year the child turns 18. Once the child is 18, those distributions, if they take them, are going to be taxed like a traditional IRA. That means that any after-tax contributions, so those contributions that were made by family members primarily, those are withdrawn tax-free. But any withdrawals of earnings, so remember, the earnings in these accounts are not taxed as it goes along. But once those earnings are withdrawn, they are taxable. And any pre-tax contributions, so those are contributions that are made by the IRS, by any other governmental or not-for-profit entities, and by employers. When you withdraw those amounts, those are also taxable. So what will happen is, if you take a distribution, the plan administrator will determine how much of the distribution is from after-tax contributions that are not taxable, how much of the distribution is from earnings or pre-tax contributions and is taxable, and then you'll get a 1099-R that shows you the amount that's taxable and the amount that is not taxable. The entire balance in the account will be available to the beneficiary once they turn 18, but they do have to pay tax on the taxable portion that is distributed, and presumably they will have to pay a 10% penalty for any amounts that are distributed prior to age 59 and a half, unless they meet one of those normal exceptions. The reason I say presumably is there's nothing in the law to indicate that they would not have to pay that 10% penalty. But again, I will wait to see what the IRS says when they implement this to see exactly how they say it will be handled. Moving on now to Section 529 plans and kindergarten through grade 12 expenses. So what the old law says is that distributions from 529 plans, or qualified tuition program plans, are tax-free if they are used for higher education. That's post-high school. So the way these work is you put money into this 529 plan. You do not get a tax deduction for the contribution, and the annual amounts of the contributions have limits. But you put this money in, typically it's parents, grandparents, etc., that put the money into these plans. They grow tax-free, so they're invested. They grow tax-free. And then when the child goes to college or to trade school, if they take the money out to use to pay for that schooling, then they don't pay any tax on it. So it is truly tax-free money. These amounts can be used, unlimited amounts, if it is for post-high school. They can also be used for up to $10,000 per year to pay for elementary and high school tuition, but only for tuition. So after high school, it can be used for things other than tuition, for books and fees, etc. But if it's for elementary school or high school, the old law says you can only use it for tuition and only up to $10,000 per year. What the new law says is that for elementary and high school, the amount increases to $20,000 per year. And in addition to tuition, you can also use it for other eligible expenses, such as curricular materials, books, online materials, certain tutoring, fees for standardized tests, fees for dual enrollment in college classes, and for educational therapies for students with disabilities. This expanded list of eligible expenses is effective for distributions after July 4th of 2025. However, the increased amount, the $20,000 amount, is not effective until January 1st of 2026. Credentialing expenses. So the old law says that the distributions from the 529 plan cannot be used to pay to obtain or maintain a professional credential. So it's for college costs, schooling costs, not professional credentialing costs. What the new law says is that you can use those funds for credentialing. So this includes tuition for a program to get you credentialed. It includes fees that you pay, books, supplies, equipment for any of those credentialing programs, and the fees for taking the test itself and for obtaining the credential itself. It also can be used for continuing education that is required to obtain or maintain that qualifying credential. Now, there are specific requirements for what is a qualified credential. However, the definition is quite broad. So, for example, both the enrolled agent and the CPA qualify. So if you take a CPA review course, you could use the money from your 529 plan to pay for that course, as well as paying for the fees to take the exam, etc., and so forth. And the same thing for the EA exam. And this is effective for distributions made after July 4th of 2025. Charitable deduction for non-itemizers. So the old law said that charitable contributions can only be deducted as an itemized deduction. So if you don't itemize, you cannot take a charitable contribution deduction. Now, there was an exception made during COVID for 2021 only that allowed a deduction for a maximum of $300 or $600 married filing jointly for a cash charitable deduction for non-itemizers that was made to a public charity. So it had to be cash or a check or credit card, but in other words, not property. You couldn't take a deduction for your old clothing that you gave to Goodwill or whoever. It had to be actual money out of your pocket, but you could in 2021 take this deduction of $300 even if you did not itemize. But other than that, if you didn't itemize, no charitable deduction. So what the new law does is it allows non-itemizers to take a deduction of up to $1,000 or $2,000 married filing jointly, again, for cash contributions to a public charity. What they did was they amended that old law, the 2021 law, and they changed it so that instead of being effective only for 2021, it is effective for tax years starting in 2026, and then they increased the amount to $1,000 instead of $300. This is a separate below-the-line deduction in the same category as the standard deduction or the qualified business income deduction or the tips deduction or the overtime deduction. So these are all now going to be below the line. So after you have already calculated adjusted gross income, but before you calculate taxable income. Now let's talk about charitable contributions for itemizers. So charitable contributions are allowed as an itemized deduction. That is the current law. And there is no floor to exceed before becoming deductible. What the new law does is it puts in a floor. So you're going to add up all of your itemized charitable contributions, and then they will be deductible only to the extent that they exceed 1/2 of 1% or 0.5% of the taxpayer's contribution base. Contribution base is their adjusted gross income without regard to any net operating loss. The 0.5% floor is applied after taking into account the other charitable contribution limitations, So you may remember that there are other limitations based on your adjusted gross income. So you do those limitations first. After you've done those limitations, you say, okay, how much do I have in deductible charitable contributions? Subtract 0.5% of your adjusted gross income from that amount. That will be your itemized deduction for charitable contributions. Carry forwards are allowed. So if you have more than you can use, then you can carry forward the excess to future years. And this is effective January 1st of 2026. Also, for those charitable contributions, prior to 2018, cash contributions to the so-called 50% limit organizations, which is most charities that people give money to, the cash contributions to those organizations were limited to 50% of the donor's adjusted gross income. For 2018 through 2025, that limit was raised to 60% of adjusted gross income. We still call them 50% limit organizations, but for 2018 through 2025, it was raised to 60% of AGI. And what the new law does is it makes that 60% permanent. So for now, we're still calling them 50% limit organizations. Maybe they'll change the name to 60% limit organizations. I don't know. But in any case, it is 60% of AGI rather than just 50%. And again, that is effective January 1st of 2026. Contributions to scholarship granting organizations. So this is a brand new category of organizations for which you can get actually a tax credit for contributing. So the old law, there was none, did not exist. So what the new law says is that U.S. citizens and resident aliens can get a tax credit of up to $1,700 per year for cash contributions to a qualifying scholarship granting organization that grants scholarships to eligible students for elementary and secondary education. So we're talking about grade school and high school here. The credit is non-refundable, though any excess can be carried forward up to 5 years. The amount of the credit that you take does have to be reduced by any state income tax credit that you receive for the same contribution. So if you get a state tax credit, you have to reduce your federal credit by that amount, by the amount of the state tax credit. The amounts that are used to claim this credit cannot also be used as a charitable contribution deduction. So you can take them either as a charitable contribution deduction or as a credit, but of course, it is almost always going to be better to take it as a credit. And this is effective for January 1st of 2027. So it doesn't go in effect until 2027. So what is a scholarship granting organization? What does that mean? Well, it has to meet certain criteria, including those listed here. First of all, it has to provide scholarships to 10 or more students who do not all attend the same school and are in the state where the organization is formed. That organization must spend at least 90% of its income on qualifying scholarships. The students who are receiving these scholarships must come from households with income that is not more than 300% of the area median gross income for where those scholarships are being given. The organization cannot provide scholarships for anything other than qualified elementary and secondary expenses. So it needs to be focused just on doing this, just on being a scholarship granting organization. And the scholarships cannot be earmarked or set aside for a particular student. And again, you've got the rules that it has to be for 10 or more students who do not all attend the same school. So they're trying to make sure that people aren't playing games and setting up these organizations just to get a credit for paying scholarships for their friends and relatives. That's what these rules are designed to do. And there are some other requirements as well. Moving on to Section 1202 stock gains. So you may be aware of this. This is actually a phenomenal benefit in the tax law. So what the old law says is taxpayers can exclude up to $10 million of gain on the sale of qualified small business stock that is held for more than 5 years. So there's a lot of rules that go into this, but it has to be a C corporation, has to have less than $50 million of assets, has to be owned by the original owner who actively participates in the business or given to them as pay for services, and there's other criteria that it has to meet. So it is very detailed, and you have to meet very specific criteria. But if you meet that criteria, you can completely exclude up to $10 million of gain on the sale of that stock. The new law actually enhances this. So what it says is, for stock acquired after July 4th, 2025, taxpayers can exclude up to $15 million or $7.5 million if they are married filing separately of the gain on the sale as follows. If they held the stock for 3 or more years, they can exclude 50% of the gain. So remember, the old rule is you have to have held it for 5 or more years, period. And then you can exclude 100% of the gain up to the $10 million. For this stock, this is for stock acquired after July 4th of 2025. But for this stock, if you held the stock for 3 or more years, you can exclude half the gain. If you held it for 4 or more years, you can exclude 75% of the gain. And if you held it for 5 or more years, you can exclude 100% of the gain. And these exclusion amounts will be indexed for inflation starting in 2027. Now, keep in mind, that is only for stock acquired after July 4th of 2025. If it's an older company, a company that already exists, then the old rules still are in place, which is still a great benefit. So it's $10 million for any stock that was acquired before July 4th, 25, and it's $5 million for married filing separately. That part is new. They didn't used to have a separate amount for married filing separately, but they do now. So it's $10 million or $5 million for married filing separately, and there continues to be no inflation adjustments on that amount. So it's $10 million and $5 million, no inflation adjustments. For stock acquired after July 4th of 2025, it's $15 million, $7.5 million with inflation adjustments, and you can get a partial exclusion of the gain if you held it for 3 years or 4 years, and then the full exclusion if you held it for 5 years or more. Social Security number requirement for education credit. So we've seen a little bit of this already. They've put in this new law a lot of requirements that require a Social Security number. So that is also going to happen for these education credits. So the old law was if you were taking one of these credits, the American Opportunity Credit or the Lifetime Learning Credit, you could use either the student's Social Security number. If they didn't have a Social Security number, you could use an ITIN, an Individual Tax Identification Number. Only U.S. citizens and certain legal residents can obtain a Social Security number. So under the old law, you didn't necessarily have to be a U.S. citizen or a legal resident in order to take advantage of one of these credits. But what the new law says is you can only take the credit if you have a Social Security number, which means de facto, you're going to have to be a U.S. citizen or a legal resident in order to claim one of these credits. In addition, for the American Opportunity Credit, the Employer Identification Number, or EIN, of the educational institution to which the qualifying expenses were paid must be included on the return. So typically, if you have these expenses, you will get a 1098 form from the educational institution, and that form will have on it the EIN of the institution. And if you look at the forms that were currently in place for claiming the AOC, you are supposed to put the EIN on that form. And if you read the instructions, it says you have to include the EIN on that form. However, it was not actually the law that had to be done. So what they've done now is they've said, it is the law that you have to put the EIN on the tax return in order to get the credit. So before, the IRS, they get a copy of these 1098s. So as long as they got a copy of the 1098, even if you didn't put the EIN on the tax return, they would go ahead and let you take the credit. But that is now going to change. You're going to have to put the EIN on the tax return. And all of that is effective January 1st of 2026. The Child and Dependent Care Tax Credit. So this is, under the old law, a credit that you can get for child or dependent care expenses so that you can work or so you can look for work. The credit ranges from 20% to 35% of the expense, depending on your adjusted gross income. But the maximum expense that you can use to apply this credit is $3,000 per year if you've got one qualifying person needing care, and $6,000 of expenses for two or more. So, for example, if you have 3 children who are dependents and you are paying for their daycare, the maximum amount of expenses that you can use is $6,000. Then you would take that $6,000 times your percentage. Let's say you're in the 20% AGI level. You would take $6,000 times 20%, and you would get a $1,200 child and dependent care tax credit. That's the way the law currently works. What the new law does is it expands the ranges from 20% still all the way up to 50%. So if you are a lower AGI taxpayer, so if you have $15,000 of AGI or less, no matter what your filing status is, then you get a credit of 50% of the amount of the expenses that you paid up to those same maximums. So they didn't change the $3,000, $6,000 expense limitation. Then the credit ranges from 50% down to 20%. The 20% is for taxpayers with adjusted gross income over $103,000 or $206,000 if you are married filing jointly, and all of this is effective January 1st of 2026. Adoption credit. So the old law allows taxpayers to claim a non-refundable credit of up to $17,280. That's the 2025 amount. It goes up each year with inflation per child for expenses to adopt that child. The credit begins to phase out when adjusted gross income reaches $259,190. Any excess credits, so if you've got more than the $17,280, it's not refundable, but it can be carried forward up to 5 years. What the new law says is that up to $5,000 of that credit is refundable, and that amount will be adjusted for inflation. And the refundable portion cannot be carried forward, which makes sense because you're going to go ahead and get that credit now since it is a refundable credit. For purposes of the credit, to determine if a child has special needs, that determination can be made either by a state or an Indian tribal government. So it used to be, in order to determine if a child had special needs, only the state could make that determination. What the new law does is it adds Indian tribal government so that if they make the determination, then that child counts as being special needs as well. Now we are going to move into the premium tax credit and the advanced premium tax credit. We're going to have several slides that are dealing with this. So I want to make sure we understand what the premium tax credit is. If you get health insurance on an exchange, so this is sometimes called Obamacare or the ACA, you get health insurance through the exchange, there is a cost, of course, to that health insurance. And what the government does is they help to subsidize the cost of that insurance. And the way they do that is by giving you a credit on your taxes. It is called a premium tax credit. So based on your income level, you will get a certain amount of premium tax credit. So what you have to do is estimate how much your income is going to be for the following year. Then based on that, the government will give you what's called an advanced premium tax credit. So let's say you sign up for health insurance on the exchange and your monthly cost for insurance is $1,000. But based on your income or what you estimate your income is going to be, you are entitled, let's say, to a credit of $600 per month. What the government will do is they will pay the insurance company $600 a month all during the year. You will pay the insurance company $400 per month all during the year. So the insurance company has their full $1,000, but you have only had to pay $400. The government has paid the other $600 every month. Then you file your tax return, and now you have to see how much money did I actually make. So the government based that $600 a month on your estimate of what your income was going to be for the year. So now you're doing your tax return, you have to do a reconciliation. There's a form where you do this, and you reconcile how much credit am I actually entitled to based on my actual income compared to the amount of credit that was given to me based on my estimated income. If there is a difference, so if you overestimated your incomes, you ended up making less money than you thought you were going to, then you would be entitled to a larger credit. And so then you would get a refund of the difference. However, if you ended up making more money than you estimated, then when you do that reconciliation, you're going to end up owing money because the actual amount of your credit should have been less than they actually gave you. So then you have to pay back the difference. However, under the old law, the amount that you have to pay back was limited. So no matter how much you actually owed, depending on your income level, there's a maximum that you had to actually pay back. So if your income is less than 200% of the poverty level, then your maximum amount that you have to pay back is $750. And these amounts are for everyone except for single filers. So if your filing status is single, then your amount is half of these amounts. For everybody else, these are the amounts. If your income is more than 200%, but less than 300% of the poverty level, then your maximum amount that you have to pay back is $1,950. If it's between 300 and 400%, it's $3,250. And if your income is 400% or more of the poverty level, then there is no maximum. You have to pay back whatever amount that it is that you owe. So that is the old law. So what does the new law say? Well, the new law eliminates that maximum payback amount. If the reconciliation shows that you have an amount due, then you must pay back that entire amount, and that is effective for tax years beginning January 1st of 2026. Our next premium tax credit topic has to do with eligible aliens. So the old law said that anyone who was lawfully present in the United States is potentially eligible for the premium tax credit as long as they meet the criteria for the credit. So in order to get the credit, you have to meet certain criteria. For instance, if you have health insurance, subsidized health insurance through a job, meaning your employer pays part or all of the premiums for your health insurance, then you are not eligible for the premium tax credit. So there are those types of rules that go with this. But the old law said, as long as you meet those rules and you are lawfully present in the United States, then you are eligible for the premium tax credit. What the new law says is that only U.S. citizens and eligible aliens are eligible for the premium tax credit. An eligible alien is one who is lawfully present in the United States and one of the following. So they have to fit into one of these three categories. They are lawfully admitted for permanent residence under the Immigration and Nationality Act, or they've been granted the status of Cuban and Haitian entrant under the Refugee Education Assistance Act of 1980, or they lawfully reside in the United States in accordance with a compact of free association under the Personal Responsibility and Work Opportunity Reconciliation Act of 1996. Those provisions are effective January 1st of 2027. So that's not 2026, but 2027. Next topic for premium tax credits: aliens who are not eligible for Medicaid. So again, anyone who meets the criteria and is lawfully present in the United States under the old law, they are eligible for the premium tax credit. However, one of the criteria is that your income has to be at least 100% of the poverty line. So if you make less than the federal poverty line, you are not eligible for the premium tax credit. Now, you might be thinking to yourself, Tom, that doesn't make any sense. Aren't the people who make the least amount of money most worthy of getting the premium tax credit? Well, yes, except you need to understand how our healthcare system works. If your income is less than 100% of the poverty level, then you are going to be eligible in most cases for Medicaid. Medicaid is essentially free or very, very cheap health insurance. Medicaid is a federal program, but it is administered by the states. So each state has their own rules for exactly who qualifies for Medicaid and how the system works. So there are some states whose Medicaid programs say if you fall into a certain class of alien, you are not eligible for Medicaid in that state. So what the premium tax credit law said, the old law said, if you make less than 100% of the poverty level, even though usually you would not be eligible for the premium tax credit, if you are not eligible for Medicaid because of your alien status, then you will be eligible for the premium tax credit. What the new law says is that that exception for aliens who are not eligible for Medicaid due to their alien status is eliminated. So if you make less than 100% of the poverty line, you are going to be eligible for Medicaid. Therefore, you are not eligible for the premium tax credit. If you are not eligible for Medicaid due to your alien status, then doesn't matter. You are still not eligible for the premium tax credit under the new law. And that is effective January 1st, 2026. Continuing with the premium tax credit, the exchange must verify eligibility. So under the current law, a healthcare exchange is not required to verify the applicant's eligibility to enroll in the plan. So there are multiple healthcare exchanges through which people can get their health insurance. The federal government has one. You've probably heard of that one. But many states also have their own exchange. So if your state has an exchange, that's where you go to get your health insurance through the ACA or through Obamacare. If your state does not have an exchange, then you go to the federal exchange. So there are multiple exchanges. These exchanges under the old law are not required to verify anything you tell them. They will ask you questions to determine your eligibility. They'll ask you, do you have health insurance through an employer? How much money do you make? Where do you live? Are you lawfully in the United States, et cetera, and so forth. Based on your answers to those questions, they will tell you whether or not you are eligible to enroll in the plan. but they are not required to do any type of verification of what you tell them. They can just take your word for it. Now, if you lie in the process of doing that and they find out about it, there are consequences to that. But if they never find out about it, then you could have lied and gotten your health insurance even though you didn't actually qualify. So what the new law says is that the exchange must verify that the applicant is eligible for the plan and for the premium tax credit. And they also have to verify things like their household income, their alien status, whether or not they have any health coverage or are eligible for that health coverage, their place of residence, and any other information that the IRS says they need to determine eligibility for the premium tax credit. This one is not effective until January 1st of 2028. So they are giving these exchanges a couple of years to get their systems in place and to test it out and to make sure that they can verify all of this information for people who are applying for health insurance. Next, for the premium tax credit, special enrollment period. So if you've ever had health insurance through an employer, you probably are familiar with the idea of open enrollment or the annual enrollment period. So they will tell you you can enroll in health insurance for next year from this date to this date. That's when you can do it. If you don't enroll during that period, then you may not be able to get coverage for next year. So there's a similar process with the ACA, with these exchanges. So there is an annual enrollment period in the fall of every year. If you want health insurance through the exchange for the following year, then you need to enroll during that annual enrollment period, and you do that every year. However, just like with your employer plans, there can be life events that happen that allow you to enroll even if it is outside of that normal annual enrollment period. So, for example, if you get married, if you get divorced, if you have a baby, if you lose your health insurance through a job, maybe you no longer have that job, so you no longer have that subsidized health insurance. Those things are all examples of life events. So what happens in that case is you are allowed to enroll during that time. When that life event happens, you've got so many days in order to enroll, and that is called a special enrollment period. Well, what some of these state exchanges have done is they've made a special rule for low-income people. So, for example, they might say anybody whose income is at or below 150% of the poverty line, they always have a special enrollment period. So they can enroll anytime they want to throughout the year. They don't have to wait for the annual enrollment period. Doesn't matter if they've had a life event or not. Because of their low income status, they can enroll whenever they want to. So what the new law says is you can't do that anymore. There will be no premium tax credit allowed for anyone who is allowed to enroll outside of the annual enrollment period due solely to their household income. In other words, they have not had a life event. And that is effective January 1st of 2026. And then our last topic for the premium tax credit is the sunset of the enhanced credit. So prior to 2021, there was a premium tax credit. Due to the COVID pandemic, they increased the amount of the tax credit, but only for the years 2021 through 2025. So they said, okay, people are struggling financially because of the pandemic. Plus, they need their health insurance more than they've ever needed it due to the pandemic. So they enhanced the premium tax credit, made it larger than it previously was, but only through 2025. What they also did is they said, even if your income is 400% or more of the federal poverty level, we are still going to give you some premium tax credit. You could always get health insurance through the exchange, even if your income was 400% or more of the federal poverty level. But prior to 2021, you could not get a premium tax credit. But for those years, 2021 through 2025, you could get a premium tax credit, even if your income was at that level. So what the new law does is They simply are letting this expire. So the new law doesn't address it. It doesn't say it's going to expire. It simply ignores it. By ignoring it, it will automatically expire at the end of 2025. Now, there are people who are lobbying Congress to pass a separate bill in order to extend this or to modify it or to do something other than just letting it totally go away. But we're going to have to wait and see what happens with that. So we will keep our eyes peeled. This, of course, is effective January 1st, 2026. I do want to emphasize one important point. The premium tax credit is not going away. The premium tax credit will still be there. It will just be at the same level it was prior to 2021. You won't have this enhanced credit. And the people who make 400% or more of the federal poverty level, while they can still get health insurance through an exchange, they will not be eligible for the premium tax credits. So the premium tax credit lives on, just not in its enhanced form. Now, sticking with the health insurance theme, but moving on to health savings accounts, and as it relates to telehealth. So what the old law says is if you want to make contributions to a health savings account, so those are contributions that you put money in, you get a tax deduction for putting the money in within certain limits. That money grows tax-free. And then if you use that money to pay qualified medical expenses, then you don't have to pay tax on the money when it comes out. So essentially, it's a way of making your health care expenses tax deductible because you put the money in the HSA, you get a tax deduction for that. You use that money to pay your expenses. When you use the money, you don't have to pay taxes on it. So essentially, that medical expense became tax deductible. In order to have one of these HSA accounts, or at least in order to be able to contribute to that account and get a tax deduction, you have to also have a high deductible health insurance plan, or an HDHP. And the definition of an HDHP depends on the amount of the deductible as well as other criteria. So what the new law says is that a health plan will not fail to be treated as an HDHP just because they don't have a deductible for telehealth. So again, with COVID, telehealth became much more popular. So rather than going to the doctor or going to urgent care and risking getting COVID or giving COVID to other people, the government made it easier to do telehealth. So you may have done this yourself. You use your phone or your computer and you have a video call or even an audio call with a doctor, and you tell them what's going on. And if you're on video, they can look at you and see what's going on, and then they go from there. So the health insurance companies like this because it's cheap. So they want people to use telehealth as much as possible because it's a lot cheaper for them as a health insurance company to pay that bill than it is if you go to the doctor's office or if you go to urgent care or an emergency room, for example. So those health insurance companies want to incentivize people to use telehealth. So what they will say is, you normally have this big deductible for your health insurance, but if you do telehealth, you won't have to worry about that deductible. You might have to pay a small copay or something like that. Maybe you have to pay nothing, but in any case, you have no deductible. So what the new law is saying is, even though you are supposed to have a quote unquote high deductible for your health insurance in order to qualify for an HSA, if you don't have a deductible just for this telehealth or other remote care type of services, that's okay. That will not disqualify your health plan from being considered a high deductible health plan. And that is actually retroactive to 2025. So it's plan years, that's health insurance plan years, starting after December 31st, 2024. So that means this qualifies for 2025 and then going forward. More in health savings accounts, bronze and catastrophic plans. So again, the current law says you have to have a high deductible health plan, and that has to meet certain criteria. What the new law clarifies is if you have a bronze plan offered through an exchange. So if you go out to that healthcare exchange, there are 3 levels of plans: bronze, silver, and gold. Bronze is the bottom plan, has the highest deductibles, and basically the least amount of coverage of all the plans. Sometimes those plans, even though they do have a high deductible, they may not technically meet all of the criteria to be considered a high deductible health plan. So what the new law says is if you've got a bronze plan through an exchange, it automatically qualifies as a high deductible health plan. Similarly, there are catastrophic health plans out there that have very high deductibles, and these are not necessarily even part of the exchange. These are just sold by health insurance companies to individuals. They've got high deductibles, but they might not meet all of the criteria to be an HDHP. So the new law is saying if you've got one of these catastrophic plans, then it too automatically qualifies as an HDHP, which means you can have an HSA and contribute to that HSA on a tax deductible basis. And this is effective January 1st of 2026. Then our last health insurance and health savings account topic has to do with concierge medicine. Again, the old law says you have to have a high deductible health plan, and there's all kinds of rules about what that means and what is an insurance policy. What's the definition of an insurance policy? So what the new law says is if you have a direct primary care service agreement, that will not be considered a health plan. It will not be considered health insurance, and therefore it will not disqualify you from having a high deductible health plan, and therefore will not disqualify you from having an HSA that you can make contributions to. So what are we talking about here? The law calls these direct primary care service arrangements. In the medical world, it is typically called concierge medicine. So what some doctors are doing is they are tired of the old model where people come, they make appointments, and the doctor's so busy, the appointments are like one every 15 minutes. They can only spend about 10 minutes with each patient. They don't feel like they're really providing a high level of service to those patients. So they've gone to a different model. So what they are saying to people is, if you want to be a patient in my practice, then you have to pay a monthly fee. It's kind of like a subscription model for a doctor. So they might say if you pay $100 a month or $150 a month, then you are going to get access to me. So rather than having to call the doctor's office and there's not an appointment available for 2 more months or what have you, if you are a member of their practice and you pay this monthly fee, you will have same day appointments with the doctor. As a matter of fact, a lot of the doctors will give you their cell phone number and you can text them or call them 24/7, 365 if you have a medical question. And so that way you have access to that doctor and they can spend time with you. So now when you go in to see the doctor, it's not going to be 10 minutes and they're out of there onto their next patient. They're going to be able to spend the amount of time it takes to make sure all of your needs are addressed and they can talk to you, get to know your health situation, and provide a higher level of care. So in order to get this higher level of service, you have to pay this monthly amount, whatever the amount is. And even if you don't see the doctor that month, you might not need the doctor's services for 6 months out of the year, doesn't matter. You are still paying that monthly amount for the privilege of having that access. So what the new law is saying is that if you participate in one of those, that is not health insurance. Paying that amount to the doctor every month is not quote unquote health insurance. So you don't have to worry about violating the rules about high deductible health insurance plans. Now, there are some limitations. So it has to just be for primary care. So it cannot include things like general anesthesia. If you need surgery that requires general anesthesia, and that's included in your $150 a month, then that will be considered health insurance. And so you're not going to be eligible for your HSA. So it cannot include that. Similarly, it cannot include prescription drugs other than just vaccines that you might go in and get. So if your $150 a month also includes your prescriptions, then that looks a lot like health insurance. And so that is not going to qualify. And then also laboratory services, like if you're getting blood work, if that's included, then that would be considered health insurance. But in the real world, again, these plans do not include those things. They're just putting this in here to make sure that people don't try to disguise a health insurance plan as a direct primary care service arrangement. So that is how they have defined it. Also, the fees cannot be more than $150 per month if it covers one person, or $300 per month if it covers two or more people, and those amounts will be adjusted for inflation. The law also clarifies that these fees that you pay do count as a medical expense. So remember, you pay it whether you see the doctor or not, but it says that does count as a medical expense. And all of this is effective January 1st of 2026. Moving on now to the energy credits. So for individual tax, we've got 4 credits. 2 of them are for vehicles. 2 of them are home-related energy improvements. You may have heard about this in the news. So these are credits that exist and we're supposed to keep going for several years. Essentially, what the new law does is terminate them early. So let's look at each of them. First of all is the new clean vehicle credit. So individuals can get a tax credit under the old law for up to $7,500 for the purchase of a qualifying new electric car. It has to meet several criteria, but if you meet all of that, you can get this $7,500 credit. That credit expires on December 31st, 2032 under the old law. So what the new law says is that credit now expires on September 30th, 2025. So as I record this, it is September of 2025. So this credit is going to expire at the end of the month, at the end of September. Electric vehicles that are acquired after that date are not eligible for the credit. So what does acquired mean? Well, for this purpose, it means you have a written binding contract and a payment has been made. It can be a nominal down payment. It can be a trade-in. So as long as you have a binding contract and some sort of down payment made towards that car by September 30th of 2025, then you can still get this credit of up to $7,500, regardless of when you actually take possession of the vehicle. Next is the used clean vehicle credit. So this is very similar, except the credit is a maximum of $4,000 per vehicle. That credit also is scheduled to expire on December 31st of 2032 under the old law. Under the new law, it too expires on September 30th, 2025 with the same criteria. Next are the home-related credits. So first is the energy efficient home improvement credit. So with this, under the old law, taxpayers can get a credit of 30% of the amount paid for qualifying energy efficient home improvements such as heat pumps, air conditioners, furnaces, water heaters, etc. They can also get credit for the purchase of qualifying doors and windows. There are some dollar limits on these credits, and the credits were scheduled to expire on December 31st of 2032. Under the new law, that credit expires on December 31st of 2025. Purchases made after that date will not qualify, and for this one, the item must actually be installed, completely installed, by December 31st of 2025 in order to qualify for the credit. And then our last energy credit is the residential clean energy credit. So for this, taxpayers can get a 30% credit for the amount paid for qualifying solar, fuel cell, wind energy, geothermal heat pump, and biomass fuel properties. And that credit was scheduled to expire on December 31st of 2034. Under the new law, that one also expires on December 31st of 2025. And again, it must be installed by December 31st of 2025 in order to qualify for the credit. Our next topic has to do with an excise tax on transfers to foreign recipients. And there is no old law for this. This is brand new. So what the new law says is there is a 1% excise tax on a transfer of funds, that's cash, money order, cashier's check, or anything like that, from a sender located in the United States to a recipient in a foreign country. The tax is paid by the sender, and it is collected and paid to the Treasury by the remittance transfer provider. So what we're talking about here primarily are these services like Western Union and MoneyGram, where you can send somebody money. If you send somebody money through one of these types of services from the United States to a recipient in a foreign country, then you as the sender are going to have to pay this 1% excise tax. There are exceptions for transfers from your typical bank accounts. So if you've got an account at a bank or credit union or any federally regulated financial institution, and you're transferring funds from there to a foreign recipient, you don't have to worry about this. There is no excise tax for that. Similarly, if you have a debit card or a credit card that's issued in the United States and you are sending money using that card, you do not have to pay this 1% excise tax. So this is really limited to these money transfer services, not to your typical banks. And this is effective January 1st of 2026. And our last individual tax topic has to do with direct file. You may be familiar with the IRS for the last couple of years has been running kind of a pilot program of a free tax filing website. And so far, it's been for residents of 25 states. And the plan was to expand that to everybody. But what the new law says is that the Department of the Treasury, the IRS, has to do a study on this, and they have to deliver a report to Congress within 90 days after the law was passed on July 4th, 2025. So that'll be due, in early October of 2025. So they have to look at this. They have to look at how much it costs. They have to compare it to what if we used private tax software companies to do this instead? What would that cost? What would taxpayers prefer? What are the pros and cons of each? So on and so forth. So they have to deliver this report to Congress. The basic gist of this is a lot of people in Congress do not like the fact that the IRS is in the tax preparation business, and so they're not so sure that they want to do that anymore. So their first step is, let's do this study, see what it looks like, and then we will make a determination later about what to do with direct file. So that is going to do it for the individual tax provisions. Now we will move on to the business tax provisions. The first business topic is the qualified business income deduction. So under the old law, this was new under the TCJA, so it didn't start until 2018. For 2018 through 2025, an individual can deduct 20% of qualified business income from a sole proprietorship, partnership, or S corporation, as well as 20% of income from a REIT or a PTP. A REIT is a real estate investment trust, and a PTP is a publicly traded partnership. There were limitations that apply, especially for certain businesses called SSTBs, or specified service trader businesses, such as accounting, law, medicine, architecture, etc. And the QBID is set to expire under the old law after 2025. So what the new law does is it makes it permanent, and then it makes a couple of changes. One of the changes is that the phase-out range is increased. As your income rises, the QBID can start to phase out. So there is a range that phases out between one level of income and a higher level of income. Once you're over that higher level of income at the end of the range, then you don't get any QBID. So the width, if you will, of that range, so the spread between the start of the range and the end of the range, the new law is increasing that from $50,000 or $100,000 for married filing jointly to $75,000 or $150,000 for married filing jointly. So for example, if the bottom part of the threshold of the range for married filing jointly is $394,600, then under the old law, the upper limit over which no deduction is allowed would be $494,600. Under the new law, it becomes $544,600. So that allows people to get a larger QBID, and it allows some people who wouldn't get any QBID to at least get some. In addition to that, there is a new minimum deduction that has been added by the new law. So the minimum deduction is the greater of the actual calculated amount, or $400, which will be indexed for inflation. So this applies to any taxpayer with at least $1,000 in active trade or business income. And you use the same rules that you do to determine if an activity is active or passive under the passive loss rules to determine whether or not it is active trade or business income under the QBID rules. So a couple of the things like the REIT and the PTP, those are not active businesses. Those taxpayers are not actively participating in those. So those would not count for this minimum deduction. But if you've got a sole proprietorship, a partnership, or an S Corp that you actively participate in with at least $1,000 of trade or business income, then you will qualify for this minimum deduction. And all of this is effective for tax years beginning after December 31st, 2025. Next is bonus depreciation. This was highly anticipated, and it did come through in the law. This is called officially special depreciation allowance. We usually just call it bonus depreciation, but it allows for the expensing of certain depreciable property in the year of purchase rather than depreciating it over its normal recovery period. It generally applies to new or used tangible property with a class life of 20 years or less, as well as off-the-shelf software, which is actually intangible property. In 2023, you could expense 100% of the cost of this property immediately, but then it was phasing out from there. So in 2024, it went down to 60% of the property, or 80% for certain long production period property. And then it was scheduled to keep decreasing 20% per year until it went away totally. So in 2025, it was supposed to only be 40% or 60% for the long production period property, and then 20% in 2026, 0% in 2027. With the special depreciation allowance, there are no annual limits about how much you can deduct, and it applies automatically unless the taxpayer elects out of that treatment. So what the new law does is it makes this bonus depreciation permanent at the 100% level. So we're going back as if it were 2023 again, although you cannot retroactively do this. But for property purchased January 19th, 2025 or later, you can take 100% bonus depreciation. And again, it will apply automatically unless you elect out of the treatment. If your business happened to purchase some qualifying assets between January 1st and January 19th, 2025, unfortunately, you are going to be stuck with the old law, which is that 40% of the property that you can take the bonus depreciation on. Next up is Section 179 property. Under the old law, Section 179 also allows the immediate expensing of certain assets. There is an annual limit, though, on the amount of property that may be expensed, and also the type of property is more limited than it is for bonus depreciation. Nevertheless, it is another avenue to immediately expense certain assets rather than depreciating them. The annual limit for 2025 is scheduled to be $1,250,000 of property placed in service. So you could not use the 179 deduction for more than that annual limit. That limit is also phased out dollar for dollar once total Section 179 property placed in service for the year exceeds a statutory limit, which for 2025 is scheduled to be $3,130,000. So what that means is this is designed to keep very large businesses from being able to use the Section 179 deduction. So if your total qualifying property that you place into service during the year is more than that statutory limit, so more than that $3,130,000, for every dollar you exceed that, your $1,250,000 maximum 179 deduction is reduced by $1. So what the new law does is it raises that annual limit and that phase out amount. So the annual limit for 2025 is raised to $2.5 million, and the phase out limit is raised to $4 million for 2025, and those amounts will be adjusted for inflation. Qualified production property. So non-residential, i.e. commercial, real property that is used in a trade or business must generally be depreciated over 39 years. That's the way the law has been for years and years. And that property is not eligible for either Section 179 or bonus depreciation, with just a very few exceptions. What the new law does is it creates a new class of real property called qualified production property, or QPP, which is property, real property, that is used in a qualified production activity, or QPA. This property is eligible for 100% immediate expensing, though it must be elected, so it is not automatic like bonus depreciation is. In order to qualify, the original use of the property must begin with the taxpayer. In other words, in general, except for the exception we're going to talk about next, in general, this needs to be a new property in order to qualify. So it has to be new 39-year real property in order to qualify for this. The construction on the property must begin after January 19th, 2025, and before January 1st of 2029, and it must be placed in service in the United States or a U.S. possession by December 31st of 2030. So what they are trying to do here is encourage businesses to build new factories in the United States. They're trying to encourage the U.S. production of goods and services rather than importing those goods and services. There are times when existing properties, so buildings that are already built, can also qualify for this immediate expensing. In order to qualify, the property has to be acquired by the taxpayer during the above dates. So they cannot already own it and then convert it into QPP and qualify for this. They have to acquire it after January 19th of 2025 and before January 1st of 2029. There are a couple of other conditions. One is that property could not have already been used by the previous owner in a qualified production activity. So it has to be a property that was not previously used in manufacturing or production or refining, as we're going to talk about on the next slide, exactly what a qualified production activity is. But if you are acquiring a building, in order to qualify as QPP, it cannot already be used in a qualified production activity. And also, the building could not previously have been used by the taxpayer. So maybe the business did not own the building, but they were leasing it and using it. They cannot now purchase that building, convert it to being used for a qualified production activity, and immediately expense it. That is not allowed. And also, they cannot be acquiring this building from a related party or a related entity. So they have to be buying an existing building from an unrelated party, a building they're not already using, that is not already being used as a qualified production property, and then they have to convert it into a qualified production property, and they have to purchase that between those two dates in order to qualify for this exception. So what is a qualified production activity? It is the manufacturing, production, but only agricultural or chemical production, or the refining of a qualified product. And so this includes almost all tangible products are included in this, other than food and beverages prepared in the same building as a retail establishment in which such products are sold. So, for example, a restaurant would not qualify for this. If that QPP is sold within 10 years, then it will be treated as Section 1245 property, and therefore this immediate expensing will be subject to recapture. And there are other rules that apply as well. But this is nice. This is effectively turning 39-year manufacturing type of property into property that is available for bonus depreciation. Although it's not technically bonus depreciation because it's done under a different code section, but it is the same idea. It is 100% expensing. Next is full expensing of domestic R&D. So research and experimental expenses, sometimes called research and development expenses or R&D, but the tax law tends to call it R&E. Prior to 2022, you could deduct your research and experimental expenses in full. Starting in 2022, they are not currently deductible. Instead, you have to capitalize those and then amortize them over 5 years. And if they were incurred outside of the United States, you amortize them over 15 years. Now, what the old law does allow for, though, is a 20% R&D credit for increasing your research activities. So if you meet the criteria, then you can get a credit for 20% of your qualifying R&E costs. And of course, you cannot amortize and take the credit for the same expenses. Under the new law, beginning in 2025, domestic R&E expenses are once again fully deductible. The 20% R&E credit is still available, but of course you still can't use the same expenses for both. This deduction does not apply to land or depreciable property used in research activities, so you can still depreciate those, or if they're available for immediate expensing, you can expense those, but you cannot deduct those as R&E expenses. The deduction also does not apply to expenditures to explore for oil and gas or other mineral or ore deposits. So exploring for oil and gas, for example, is not considered research and experimentation. So you cannot deduct those expenses immediately. If the taxpayer does not want to deduct these expenses immediately, they can elect instead to amortize them over 5 years, as was done under the old law. And this immediate expensing only applies to R&E expenses incurred in the United States. If those expenses are incurred outside of the United States, then they are not immediately deductible and they are still amortized over 15 years. prior year's domestic RED. So in addition to the current deductions that we just talked about, businesses can also go back. So remember, prior to 2022, these expenses were fully deductible. For 2022 through 2024, the domestic expenses were not deductible but had to be amortized over 5 years. So what the new law is doing is it is allowing taxpayers to go back and amend their 2022, 2023, and 2024 tax returns in order to deduct those expenses in full rather than amortize them. In order to do so, they have to make an election to do so by July 4th of 2026, and they have to amend those tax returns. As an alternative, businesses can elect to deduct the unamortized domestic R&E expenses from 2022 through 2024, and they do that by deducting them ratably over 2 years on their 2025 and 2026 tax returns. Either of these methods is considered a change in accounting method, and therefore the taxpayer will have to fill out the Form 3115 and go through that whole process. So what they've got here is two different options. First one, for those expenses 2022 through 2024, you can go back, amend the tax returns, and immediately expense those domestic R&E expenses rather than amortizing them. The second one is, if you don't want to amend your previous tax returns, what you can do instead is deduct the amount that you have not previously amortized. So if you set those up as an asset, you capitalize them in 2022 through 2024, they have not been totally amortized yet because you had to do that over 5 years. So that means there is remaining on your balance sheet an asset that is these R&E expenses. So what they're saying is you can just go ahead and deduct the full amount of that asset now, although you have to do it spread out over 2 years in 2025 and 2026. So you can do either of those two options. I guess you actually have a third option, which is to do neither of those things and to just amortize them as you were doing before. But this is a bit unusual in the tax law, and it's a nice perk for these companies that you can actually go backwards and get the full benefit of the new law. Section 163J, Business Interest Limitation. Under the old law, Section 163J limits the deduction for business interest expense for large businesses. And when we say large businesses here, that's when we're looking at your average annual gross receipts over the last 3 years. And if they are more than that magic number, which increases every year, in 2024, it was $30 million. For 2025, it's $31 million, etc. So if you are a business with annual gross receipts over that number, then under 163J, the amount of business interest expense that you can deduct is limited. The amount that those businesses can deduct is determined by adding up 3 different numbers. First, business interest income. Second, 30% of something called adjusted taxable income, or ATI. And then third, floor plan financing interest. So this is for motor vehicle dealers such as car dealerships. For any inventory that they have, so they buy the cars or trucks or tractors, whatever it is, they buy that, they keep them in inventory to sell to their customers. Their interest on that is called floor plan financing. That is completely deductible. There is no limit on that. So you get to add 100% of that when you are determining your overall business interest expense. When we talk about adjusted taxable income, or ATI, it starts with taxable income and disregards investment income and losses, business interest income, any net operating loss, and any qualified business income deduction. Prior to 2022, you also added back depreciation, amortization, and depletion. And that's a good thing because remember, part of the formula is you get 30% of your adjusted taxable income. So the higher your adjusted taxable income is, the larger your business interest expense can be. So by adding back depreciation, amortization, and depletion, you make your ATI higher, which allows you to deduct more business interest expense. But for the years 2022 through 2025, you are not able to add back those things. Also, under the old law, if you did have excess business interest expense above the limit, then you could carry that forward indefinitely and use it as a business interest expense in future tax years. So what does the new law do? One of the big things it does is that when you are determining your ATI, you once again can add back depreciation, amortization, and depletion. So again, that results in higher ATI and thus a higher interest deduction. So this is sometimes called using EBITDA rather than EBIT. So EBITDA is earnings before interest, taxes, depreciation, and amortization, and EBIT is just earnings before interest and taxes. So under the new law, you can once again use EBITDA to determine your adjusted taxable income. Unfortunately for this one, you cannot go back in time to those previous years and use this higher ATI. This is only going to be effective for years going into the future. The next provision is that certain foreign source income is now excluded from ATI. So this is a negative for the taxpayer. So certain foreign income, Subpart F income, something called net CFC tested income, which has to do with income from intangibles in foreign countries, and any associated Section 78 gross up, those are not included in ATI. That results in lower ATI and thus a lower interest deduction. All of this is effective for January 1st of 2026. Also, one other thing that the law does is it changes the definition of floor plan financing. So it is now expanded to include dealers of any trailer or camper which is designed to provide temporary living quarters for recreational, camping, or seasonal use, and is designed to be towed by or affixed to a motor vehicle, and that is effective January 1st of 2025. So it used to just be motorized vehicle dealers that qualified for floor plan financing. They are expanding that now to these trailers or campers that are carried behind a motor vehicle. Next on 163J is capitalized interest. So under the old law, deductible business interest is limited for large businesses, as we said, and any excess can be carried forward indefinitely. Capitalized interest is not included in the definition of business interest under the old law. So sometimes interest, instead of expensing it immediately as business interest, that interest is capitalized into an asset. Sometimes the law requires it to be capitalized into an asset, and sometimes the taxpayer can make an election to capitalize it into the cost of an asset. So, for example, UNICAP for inventory, certain interest cannot be immediately expensed, but has to be added to the inventory. Then, when that inventory is sold, the business gets a deduction for cost of goods sold. And sometimes the taxpayer can make an election to include it into the cost of an asset. So what some businesses were doing in order to get around this business interest expense limitation is they would elect to capitalize as much interest as they could under the law. Then they would either depreciate or under Section 179 or under bonus depreciation immediately deduct the cost of that asset. So in essence, they were able to immediately deduct the business interest that they had capitalized into that asset. So it was a way around these rules. So what the new law does is it stops that. So it says now, when you are determining your business interest for purposes of the limitation, you have to include any interest that is being capitalized as well. So this means that this limitation, 163J limitation, applies before a determination is made to capitalize the interest. The limitation is applied first to the capitalized interest. Any disallowed interest that is carried forward is not treated as capitalized interest. And so this closes that loophole that we talked about. This is effective January 1st, 2026. Paid family and medical leave credit. Under the old law, eligible employers could claim a credit of between 12.5% and 25% of wages paid to qualifying employees when the employee is on family and medical leave, or FMLA is frequently called. Among other criteria, the employee must have been employed by the employer for at least 12 months, and the wages deduction must be reduced by the amount of the credit. So you are getting a credit for part of the wages you paid. You cannot also deduct that same amount. So you have to reduce your wages expense by the amount of the credit. And this credit under the old law is set to expire after 2025. What the new law does is it makes the credit permanent, and it changes the rules a little bit. So first of all, eligible employees must work at least 20 hours per week. It used to be based on how much money the employee made. Now it's based on their number of hours that they work per week. And the employer can elect a 6-month minimum employment period rather than 12 months if they want to. There's also an alternative that can be used. Instead of using the actual wages that are paid while an employee is out on FMLA, the employer, if they have purchased insurance that will pay the wages for them in case an employee goes out on FMLA, they can take the credit on the amount of the insurance premiums paid. And if they do it that way, they get the credit on the insurance premiums paid even if no employees ever go out on FMLA. So there are insurance companies out there that will go to a business and they say, hey, we will sell you a policy. So if any of your employees go out on FMLA, you, the business, will not have to pay their wages. We, the insurance company, will pay their wages while they are out on FMLA. So what the new law is saying is if you buy one of those policies, then you can use the amount of the premium that you pay for the policy to claim the credit. And this is effective for tax years beginning after December 31st of 2025. Next are certain business meals. So under the old law, meals provided to employees on the employer's business premises for the convenience of the employer are 50% deductible through 2025. De minimis meals that are supplied to the employees are also deductible. So that's very small amounts that might be provided. Starting in 2026, under the old law, those meals will no longer be deductible. The new law allows those deductions to expire, but it adds a couple of exceptions. First of all, meals that are provided to employees of businesses who sell food. So, for example, restaurants. And secondly, meals that are provided on certain commercial vessels, in fish processing facilities, and on oil and gas platforms. Those will also be deductible. And these meals, for both of these exceptions, will be fully deductible, not 50%. Now, none of this affects the normal 50% deductibility of business meals. So those meals when you're out with clients or prospects or employees, etc., and meals while traveling. Those are all still 50% deductible. It also does not affect company parties or events where meals are provided to the public as well as to the employees. Those are still deductible. And all of this is effective for amounts paid or incurred starting January 1st of 2026. Advanced Manufacturing Investment Credits. So there is something under the old law called the CHIPS credit. So eligible taxpayers get a 25% credit for qualified investment in a facility that manufactures semiconductors or semiconductor manufacturing equipment. And the construction of that property must begin by December 31st, 2026. So they're trying to encourage people to build semiconductor chips in the United States. Under the new law, effective for property placed in service after December 31st, 2025, the credit is increased to 35%. However, the December 31st, 2026 deadline is still in place. So basically what this is doing is for 1 year, for 2026, it's increasing the credit from 25% to 35%. But as it stands now, the credit will expire after 2026. The employer-provided child care credit. So Congress wants to encourage businesses to provide child care for their employees. So under the old law, employers can receive a tax credit of up to $150,000 per year for providing child care facilities or services to their employees, or for paying someone else to provide those services. So they can either have their own child care facility, get a credit for that, or they can pay a child care provider to provide child care for their employees, and they can get a credit for that. So the credit is equal to 25% of any qualified child care facility that the employer has, or 10% of the qualified child care costs that they use to pay somebody else. Under the new law, this credit is increased to 40% for large businesses and 50% for small businesses if they have their own child care facility for those expenditures. The maximum credit is increased to $500,000 per year for large businesses and $600,000 per year for small businesses, and those amounts will be adjusted for inflation. And when we're looking at what is a large or small business, again, we're kind of looking at that same magic number we've talked about before. You're looking at your average annual gross receipts, and are they at least $31 million for 2025? Except for this credit, instead of looking at your average annual gross receipts over the last 3 years, you look at those over the last 5 years. Also, what the new law says is that expenditures for facilities that are jointly owned by the taxpayer and another entity also qualify for the credit. So the company doesn't have to own the facility 100% themselves in order to qualify for the credit. And amounts paid to intermediaries rather than directly to the child care facility itself for child care also qualifies. So if you've got somebody out there who's helping you to find child care facilities for your employees, and you pay them the money instead of paying it directly to the child care facility, you can use those amounts for the credit as well. And all of this is effective for amounts paid or incurred after December 31st, 2025. Dependent Care Assistance Program. So under the old law, employer-provided dependent care assistance of up to $5,000 is excluded from the gross income of the employee. What the new law says is that amount is increased to $7,500, or half that amount if it is married filing separately. And this is effective for January 1st of 2026. Employer-paid student loans. So under the old law, educational assistance that is provided by an employer is excluded from the employee's income up to $5,250 per year. That amount is not adjusted for inflation. It's been $5,250 for many years. Through the end of 2025, educational assistance also includes employer payments towards the employee's student loans. But that student loan provision is scheduled to expire after 2025. What the new law does is it makes those employer payments towards the employee's student loans permanent, and it indexes the $5,250 limit for all educational assistance for inflation starting in 2027. So from now on, if the employer pays part of the employee's student loan, that is excluded from the employee's income up to the limit, along with any other educational assistance that the employer gives up to the limit. And then the limit will finally start to be indexed for inflation. That is all effective January 1st of 2026. Bicycle commuting benefits. So under the old law, qualified transportation fringe benefits that are paid to an employee are excluded from the employee's taxable income. Prior to 2018, to the TCJA, certain bicycle-related expenses fit into this category. They counted as a qualified transportation benefit, but the TCJA suspended that classification. But under the old law, that is set to return after 2025. So in 2026, those bicycle commuting benefits would once again be excluded from the employee's income under the old law. But the new law says, no, that's not going to happen. Any reimbursements for qualified bicycle-related expenses are no longer considered qualified transportation fringe benefits, and therefore they are made permanently taxable. Investment income of private colleges. So certain private colleges and universities under the old law are subject to a flat 1.4% excise tax on their net investment income. So these are private universities. They usually are not going to be paying income tax, but this is an excise tax on their endowments. So a lot of times they've got pretty large endowments that earn investment income. And so this is a flat 1.4% tax on that net investment income. What the new law does is it expands this a little bit. It raises the amount of that excise tax on many of these private colleges and universities. So under the new law, the excise tax will be either 1.4% for smaller endowments, 4% for medium-sized endowments, and 8% for the largest endowments. Also, the definition of what is net investment income that's subject to the excise tax is expanded to include student loan interest that is received by the university and royalty income from intellectual property. And then the last thing this law does is it actually raises the number of tuition-paying students that are required to trigger the tax. So under the old law, this tax was applicable to any private college or university that had at least 500 tuition-paying students. The new law raises that to 3,000. So the very smallest private colleges and universities will no longer have to worry about this excise tax. But those that have 3,000 or more tuition-paying students will be subject to this excise tax and potentially will be paying a larger excise tax than they were before. And this is effective for tax years beginning after December 31st, 2025. Excess compensation in tax-exempt organizations. So under the old law, tax-exempt organizations are subject to an excise tax on executive compensation in excess of $1 million and on excess parachute payments made to such executives. And the rule applies to the 5 highest paid employees of the organization. So again, these are organizations that are not paying income tax, so this is done as an excise tax. Under the new law, the excise tax will apply to all of the organization's employees and former employees who receive more than that $1 million. And this is effective for taxable years beginning after December 31st, 2025. Opportunity zones. Under the old law, there is something called opportunity zones. And this is to provide tax incentives for investments in low-income communities. This was started with the TCJA. This is scheduled to expire at the end of 2026. What the new law does is it makes these opportunity zone programs permanent, and it modifies some of the rules. The effective dates vary depending on which provision we're talking about. If you are interested in this, this is code sections 1400Z-1 and 1400Z-2, and under the OBBBA, it is section 70421. Why am I telling you that? Because in the new law, this is actually about 10 pages of law. It is very detailed. And if you're interested in it, then you can go look it up and read it and see how it applies to you. The rest of you do not want to hear me drone on about 10 pages of what exactly qualifies as an opportunity zone and what doesn't, and what all the minutia of the rules are. So if you're interested, you can go look that up. The main thing we want to know is that this is being continued, it's made permanent, and there are some changes to the rules. Low-income housing tax credit. So under the old law, there is a low-income housing tax credit. It gives designated housing credit agencies the authority to award tax credits to applicants to construct affordable rental housing. So these are called either 9% credits that are made available through a competitive bidding process, or 4% credits that are made available on a non-competitive basis for projects that are funded by private activity bonds. The number of credits that can be handed out by these agencies is limited by law. What the new law does is it increases the number of 9% credits that are available. It increases it by about 12%. For the 4% credits, it makes it easier to qualify by lowering the minimum percentage of something called volume cap financing from 50% to 25% for certain buildings. So if you are in this low-income housing tax credit space, you know what that means. But all of this is effective January 1st of 2026. The new markets tax credit. So under the old law, there is this new markets tax credit that incentivizes private investment in low-income communities. Investors get a tax credit. It's 39% of a qualified investment, but it's claimed over 7 years, for investing in something called community development entities, or CDEs. Those CDEs then turn around and invest in businesses or projects in designated areas. And this is scheduled to expire after 2025. And so the new law makes these credits permanent, and it is effective in 2026. Charitable contributions by C Corps. So earlier we talked about changes to the charitable contribution rules for individual taxpayers. There are also changes for C corporations. So under the old law, charitable contributions by C corporations are deductible, but they are limited to 10% of the corporation's taxable income. If the corporation has excess contributions over that amount, those can be carried forward and deductible for up to 5 years. Under the new law, the charitable contributions are deductible by the C corporations only to the extent that they exceed 1% of taxable income. So they're putting a floor, a 1% of taxable income floor on charitable contributions by C corporations. So if their charitable contributions are less than 1% of their taxable income, they do not get to deduct any of them. And they are limited to 10% of taxable income still, so that has not changed. So if they have charitable contributions over 1%, they still don't get a deduction for the first 1%, but they do get a deduction for the amount over the 1%, but only up to 10% of their taxable income. But they can still carry over the excess. So if they've got more than 10%, it can still be carried forward up to 5 years. But no carry forward is allowed for the contributions under the 1% floor. So you can't say, well, I got 0.5% this year and 0.5% next year and 0.5% the year after that. and then eventually you have enough and you deduct them. You're not allowed to do that. So those under 1% floor contributions cannot be carried over. And also carry forwards cannot increase a net operating loss. And all of this is effective for tax years beginning after December 31st of 2025. Percentage of completion method. So this relates to the construction industry. In the construction industry, there is something called the percentage of completion method of accounting. And what it does is it recognizes revenue over a contract's lifespan rather than all at once upon the completion of the contract. So obviously, a lot of construction projects can take a long time. They can take several years. So under the tax law, you cannot wait until you have finished the project several years down the road in order to recognize and pay tax on the income from that project. Instead, you have to include income every year as the project is completed. So if you've completed 20% of the project in a particular year, then you're going to pay tax on 20% of the anticipated profit from that project. That's the percentage of completion method in a nutshell. Of course, it's much more complicated than that, but that is the basic idea. This is mandatory for tax purposes for most long-term contracts, but there are a couple of exceptions. First of all, for home construction. So if you are building houses, then you do not have to use the percentage of completion method of accounting. Also, for small taxpayers, they do not have to use the percentage of completion method if a contract is estimated to be completed within 2 years. And again, for small versus large, we use that average gross receipts over the last 3 years test. So that's the old law. Usually you use percentage of completion, but not if you're building houses. And if you're a small taxpayer, not if the project is estimated to be completed within 2 years. So what the new law does is it changes home construction to residential construction. So now it's not just houses that meet the exception. It's any type of residential construction, such as apartment buildings or dormitories, etc. And then it also eliminates a provision. So there used to be a separate provision for residential construction that was not houses. Well, since it's all treated the same now, they got rid of that provision. The new law also increases that 2-year rule to 3 years. So for small taxpayers, for any contract that's estimated to be completed within 3 years now, they do not have to use the percentage of completion method. If you meet the exception, then you can use a different method of accounting, which usually is the completed contract method, which, as we discussed, is where the profit or loss on the project is not recognized until the year in which the project is actually finished. And this is effective for all contracts entered into in tax years beginning after July 4th of 2025. $10.99 reporting thresholds. This is another one that taxpayers and especially tax preparers have really been looking forward to, and it did make it into the law. So under the old law, a trade or business that pays more than $600 per year of certain amounts to non-corporate taxpayers have to issue that person a 1099, and they have to send a copy of that to the IRS. So this is for non-employee compensation, for rents that are paid, and other amounts that go on a 1099 miscellaneous, and so forth. And that same threshold, the $600, is used to determine when backup withholding applies. So if you are paying amounts to someone, they are supposed to give you send them a W-9 form, they put on their business name and address and their taxpayer identification number, and you use that to issue them the 1099. Well, if they don't fill that out for you, then you have to actually withhold some money for taxes from the amounts that you're giving them. and we use $600 as the threshold for that backup withholding. The new law changes this to $2,000 per payee rather than $600. Unfortunately, this does not start until payments made in 2026. So for 2025, so these are the 1099s that we will be doing in January of 2026, it is still $600. But starting the next year, it will go to $2,000, and then it will be indexed for inflation from there. So that is nice. And this is, again, effective for payments made starting January 1st of 2026. 1099K reporting thresholds. So these are 1099s that are issued by, for example, credit card companies and for apps that process payments or accept payments to facilitate the sale of goods and services. These are called third-party settlement organizations. So this could be, for instance, if you drive for Uber or Lyft, you would get a 1099K if you meet the requirements. Also, if you are selling goods on an online platform, and that platform is facilitating the sale, they are collecting the money from the customer and paying the money over to you, they would issue you a 1099K. So prior to 2024, the threshold for needing to issue one of these 1099Ks was pretty high. They had to have paid you at least $20,000 during the year, and that had to be over more than 200 transactions. You had to meet both of those. It had to be $20,000, and it had to be more than 200 transactions. Well, starting in 2024, that threshold was changed to $5,000 without any regard to the number of transactions. For 2025, it's scheduled under the old law to go to $2,500, and then in 2026, it was going to go all the way down to the same $600 that is used for all the other 1099s. So what the new law does is for these third-party settlement organizations, for the 1099Ks, it changes that threshold back to those same levels from 2023. So it's $20,000 in payments and more than 200 transactions. If you're paying less than that, you do not have to issue a 1099K, and the same amounts are used to trigger backup withholding. This is effective for all transactions after 2023. So that means it's effective for even transactions in 2024. Now, of course, those 1099Ks, for the most part, have already been issued, so it is a moot point for most of them. However, what this should do is give some penalty protection from anybody who did not issue 1099Ks to the people who had under $20,000 and under 200 transactions. We'll have to see how that actually works. But if somebody did not send a 1099K when they should have, they would normally be subject to penalty for that. But this new law should allow them to not have to pay that penalty. At least it gives them a very good argument. No tax on tips reporting. So earlier, when we were talking about the individual tax provisions, we talked about how there is now this tip deduction for qualified tips. And in order to take that deduction, if you'll remember, the amount of the tips had to be reported to the taxpayer on a Form W-2 or a 1099. So now we're looking at how does this affect the businesses who have to issue these W-2s and 1099s. So what the employers and other businesses that report this income will need to do is they will need to separately identify on the W-2 or the 1099 the amount of eligible tips from the other amounts paid, and they will have to include the recipient's occupation, because remember, it is only occupations who customarily and regularly receive tips as of December 31st of 2024, according to a list that's going to be put out by the IRS. It's only those occupations that are going to be eligible for this tips deduction. So the employer or the business that is reporting these tips is going to have to put the recipient's occupation on there, as well as separately identifying the amount of the tips on that form. This is effective January 1st of 2025, but for 2025, there are some transition rules in place that allow separating or estimating the tips via any reasonable method that is allowed by the IRS. So businesses didn't realize they were going to have to do this until the law was passed on July 4th of 2025. So what they're saying is that for 2025, you may not have a perfect system for doing this, for separating the tips. So the IRS is going to come out with some sort of guidance that's going to tell you how you can reasonably estimate those amounts and report that for 2025. Next is a similar concept for the no tax on overtime reporting. So as you'll remember, individuals are going to get a deduction for the amount of overtime pay that they receive. But in order to do that, that's going to have to be separately identified on the W-2. So, of course, now employers are going to have to do that. They're going to have to put separately on the W-2 the amount of overtime that was paid. And again, there are these transition rules for 2025. You can use any reasonable method to determine that amount, as will be defined by the IRS. Extension of the tip credit to beauty service businesses. So under the old law, there is a tip credit that is allowed for employers in the food and beverage industry. The credit is the amount of Social Security and Medicare tax that is paid by that employer on tips that are received by the employee, less the amount of tips that are paid to meet the federal minimum wage that was in effect on January 1st of 2007, which was $5.15 per hour. So what are we talking about here? In the food and beverage industry, of course, people customarily get tips. That is the largest part of their income in general. So in a lot of states, servers and others who work in the food and beverage industry do not have to be paid the full minimum wage. They can be paid by the employer less than the minimum wage because they are then receiving these tips that more than make up for the minimum wage. So the employers have to keep track of these tips and they have to report them on their W-2 to the employee. And the employer has to pay the employer's share of Social Security and Medicare tax on those tips. So even though it's not an amount the employer actually paid, the customers actually paid the tips, the employer didn't, but still the employer has to pay the employer's share of Social Security and Medicare on those tips. So what this tip credit does is it gives them an income tax credit for the amount of Social Security and Medicare tax that they paid on the tips. But it does not give them a credit for the amount of tips that would get that employee up to the federal minimum wage. So if they're paying the employee less than the minimum wage, they still have to pay the equivalent amount of Social Security and Medicare tax as if they were paying the minimum wage. But any tips above that amount, they can get a credit on their income taxes for paying the Social Security and Medicare tax. That's the old law. It only applies to businesses in the food and beverage industry. Under the new law, that same credit is now being extended to beauty service businesses. So that's barbering and hair care, nail care, aesthetics, and body and spa treatments. For purposes of the beauty care businesses, the minimum wage that is used is the current minimum wage, which is $7.25 per hour. For the food and beverage establishments, though, it is still the old minimum wage of $5.15 per hour. And this new law is effective January 1st of 2025. Car loan interest reporting. So remember when we talked about individual tax, the interest that individuals pay on certain car loans is going to be deductible. So now we're talking about this from the lender's perspective. Of course, under the old law, there was no information reporting required for car loan interest because there was no need for it. Under the new law, businesses that are in the vehicle loan business that receive $600 or more of interest in a year from an individual on a new car loan on a specified passenger vehicle must issue a statement to the payor by January 31st of the following year, and a copy has to be sent to the IRS. So that presumably will be a 1098. So just like mortgage interest is reported on a 1098, certain other payments, such as tuition payments, are included on a 1098-T. Presumably, there will be a 1098 for this car loan interest as well. The IRS will be issuing guidance on exactly how to do this, and this is effective for 2025 and future years. Sound recording production costs. So in the television and film industry, you have television and film production costs. Under the old law, those are fully deductible in the year that they are paid. But it is different under the old law for production costs for sound recordings. So those that are incurred by music producers or artists or record labels, for example. Those cannot be immediately expensed. Instead, they have to be capitalized and then amortized over the life of the recording. So this is things like studio rental, engineering fees, payments to studio musicians. Those kinds of costs cannot be immediately deducted. They have to be capitalized and amortized. So what the new law does is it puts the sound recording production costs on the same footing as the television and film production costs. So what it says is for 2025, it's kind of a transition year because the law came into effect halfway through the year. So what it says is for 2025, up to $150,000 of eligible sound recording production costs can be immediately expensed. The recordings must be produced, though, in the United States. So it applies to tax years ending after July 4th of 2025 and terminates for any expenses for any sound recording commencing after December 31st, 2025. That's because starting January 1st of 2026, all of the qualified sound recording production costs are going to be eligible for bonus depreciation without dollar limits. So they will all be completely deductible starting in 2026. Interest on agricultural property loans. So under the old law, interest income received by lenders is, of course, 100% taxable income. Under the new law, for qualified lenders, 25% of interest received on any qualified loan secured by rural or agricultural real estate or a leasehold mortgage on rural or agricultural real estate is excluded from income. The borrower, though, must not be a specified foreign entity, and the refinancing of a previous loan does not qualify for this exclusion. So Congress here is trying to encourage banks and other lenders to lend to farmers, basically. And so they are encouraging that by allowing those lenders to exclude 25% of the interest income from taxable income. A qualified lender is a U.S. bank or savings association, insurance company, or entities that are owned by them, and any federally chartered instrumentation of the United States. Rural or agricultural real estate means any real property which is substantially used for the production of one or more agricultural products, or in the trade or business of fishing or seafood processing, and any aquaculture facility, such as a hatchery, a rearing pond, a raceway, a pen, or an incubator. But the property must be located in the United States or one of its possessions. This is effective for loans made after July 4th of 2025. Capital gains on sale of farmland. So under the old law, capital gains on the sale of farmland are taxed like any other capital gains of business real estate. Under the new law, the tax on the gain from the sale or exchange of qualifying farmland to a qualified farmer can be recognized over 4 years in equal installments. So in other words, instead of having to recognize the entire gain in the year of sale, you can spread that out over 4 years. This is an election that is made by the seller of whether or not to do this. And in the case of partnerships or S corporations, the election is made at the partner or shareholder level. In order to qualify, the land must be in the United States and have been used by the taxpayer as a farm or leased to a qualified farmer for farming purposes during substantially all of the 10 years prior to the sale. Also, the sale must include prohibitions on non-farm use for at least 10 years after the sale. And the sale, remember, has to be to a qualified farmer, which is defined as an individual actively engaged in farming as defined in the Food Security Act of 1986. So what are they doing here? They are trying to encourage farmers to keep their land as farmland. So they are encouraging people who are in the business of farming to sell their land to another farmer rather than selling it to someone who's going to build a subdivision, for example, or who is going to build a warehouse. They're trying to keep farmland farmland, so they are encouraging that by allowing you to spread out the gain from the sale of that farmland over 4 years. And all of this is effective for tax years beginning after July 4th of 2025. Intangible drilling and development costs. So under the old law, a C corporation is subject to the alternative minimum tax if its adjusted financial statement income exceeds $1 billion per year. When you are determining that adjusted financial statement income, intangible drilling and development costs are not allowed as a deduction under the old law. Under the new law, those costs are allowed as a deduction. So that is going to lower your adjusted financial statement income and therefore lower your alternative minimum tax, or even whether or not you have to pay the alternative minimum tax. This is effective for tax years beginning after December 31st, 2025. Excess business losses. Under the old law, non-corporate taxpayers cannot deduct excess business losses, but instead must treat them as a net operating loss. An excess business loss is when trade or business loss deductions exceed gross income or gains from the business, plus an inflation-adjusted threshold amount, which for 2025 is $313,000 or $626,000 for married filing jointly. This provision is set to expire for tax years beginning after 2028. So what the new law does is it makes this limitation on excess business losses permanent. So this is effective for tax years beginning after December 31st, 2026, and there is a new inflation adjustment formula for years after December 31st, 2025. Payments to partners. So under the old law, there is this concept of a disguised sale. So there are these rules that prevent partners from making what amounts to a taxable sale of property to the partnership look like a tax-free partnership contribution and subsequent tax-free distribution to the partner. So, for example, you may have a partner who contributes in a tax-free, quote unquote, contribution. They contribute a building to a partnership. And then magically, 6 months, a year, 18 months later, the partnership makes a quote unquote distribution, a tax-free distribution to that partner in an amount that is equal or approximates the fair market value of the building that that partner had contributed. So this is called a disguised sale. The law says, no, we see what you're doing here. You're not actually making a tax-free contribution to the partnership and then coincidentally getting a tax-free distribution from the partnership. What you're really doing is selling that building to the partnership. So there is this code section, section 707A2, that disallows this, or that reclassifies this as a disguised sale, and therefore it is a taxable transaction. But that code section, as it is written under the old law, is prefaced with this phrase. It says, under regulations prescribed by the Secretary. Well, the problem is the IRS never issued any final regulations. And so there's been a lot of controversy about whether or not this provision even applies. So what the new law does is it replaces that under regulations prescribed by the Secretary language with except as provided by the Secretary. So that allows the IRS to issue authoritative guidance without having to actually issue final regulations. This is effective for transactions commenced after July 4th, 2025, and the law does state explicitly that nothing in this section should be construed to create an inference with respect to the proper treatment of any relevant transactions that commenced before July 5th of 2025. So in other words, they're saying we're not getting involved in all of the litigation that's happening over this code section prior to this new rule being put into place. Excessive compensation in a controlled group. So under the old law, for publicly held corporations, no deduction is allowed for compensation in excess of $1 million to certain covered employees. So this is usually the CEO, the CFO, and the other three most highly compensated executives. So they can still pay them over $1 million. They just don't get a deduction for the excess over $1 million. This law is scheduled to expand to cover the next 5 highest paid employees after December 31st of 2026. And all of this applies to the compensation paid to a covered employee by all the entities that are included in any consolidated tax return. So if you've got a consolidated tax return of multiple corporations, if any of those corporations pay an executive an amount of money, we're going to add it all together. We're going to add up all the pay from all those companies. If it's more than $1 million, then the excess is not deductible. What the new law does is it expands this limitation to not just those companies that are included in a consolidated tax return, but to all members of a controlled group and an affiliated service group. So those things have very specific definitions within the tax law. But if you meet those definitions of being in a controlled group or an affiliated service group, even if you don't file a consolidated income tax return, we're going to count amounts paid by any of those companies towards this $1 million limit. The expansion of the number of specified covered employees to include the next 5 highest paid employees after 2026 remains in place. So they are still going to do that. And the determination of who qualifies for all of this is also going to be determined based on the controlled group or the affiliated service group. So they're going to look at everybody within there and they're going to see, okay, who are the highest paid people, taking into account amounts paid to that individual by all of those companies. And this is effective for taxable years beginning after December 31st, 2025. Employee Retention Credit, or ERC. So under the old law, there was a COVID-19 era program called the Employee Retention Credit. This was a payroll tax credit that was for employers who continued to pay their employees despite having significant decreases in revenue or being fully or partially shut down by government orders due to the pandemic. It generally applied from the second quarter of 2020 through the third quarter of 2021. It could be the fourth quarter of 2021 in some limited cases. This had very strict rules for eligibility, and in many cases, income tax returns had to be amended to reduce salaries and wages expense for the credit taken. So, of course, all throughout the tax law, you cannot take a deduction and a credit for the same expense. So you had salaries and wages that you were paying to these people. If you got an ERC, an employee retention credit, you could not then deduct the same wages. So if you did not take the ERC at the time, which as we'll discuss, a lot of people did not, they amended their payroll tax returns later, then you also would have to go back and amend your income tax return to reduce your wages and salaries expense. So many employers either didn't know about this credit at the time, or they didn't know that they qualified for the credit, so they did not claim it on their original 941, their original payroll tax return. But what they could do is they could go back and amend those 941s in order to take the credit. So this resulted in many advisors encouraging businesses to take the credit, even if they didn't actually qualify. You probably heard the radio ads and the internet ads and the television ads of these companies saying that you can get a credit for up to $27,000 per employee. Call this phone number and we'll help you through the process. And so these companies, they became called credit mills. They would take businesses, they would just tell them, yep, you qualify. Then they would file an amended 941 and they would take as their fee a percentage of the amount of credit that was received. And these credits could be huge, hundreds of thousands and even millions of dollars, depending on how many employees that these businesses had. So the IRS discovered a lot of fraud in this area, and this has resulted in both criminal and civil enforcement actions, which are ongoing. That's still happening. So what the new law does is, first of all, it says any original or amended payroll tax returns for quarters 3 and 4 of 2021 to claim the credit that were filed after January 31st of 2024 are not eligible for the credit. The other thing it does is it puts in this penalty for ERC promoters who do not meet due diligence, documentation, and other requirements. They are now subject to penalties of $1,000 per return, and there are other penalties that can also be imposed, as well as the criminal sanctions that are already in place. In addition, IRS assessment periods are increased to 6 years to include the income tax returns that were affected by the ERC. So normally, the IRS assessment period is 3 years. This increases it to 6 years, not only for the payroll tax return, but for any related income tax returns. And all of this is generally effective July 5th of 2025. Spaceports. This may be my favorite provision of this whole law. Under the old law, interest received on qualified private activity bonds is treated as tax-exempt municipal bond interest. And qualifying private activity bonds, includes those that are used to provide an airport. Under the new law, for purposes of these private activity bond rules, spaceports will also be treated as airports. So spaceports are facilities that are related to launching and or re-entry of spacecraft. So welcome to the future. This is effective July 5th, 2025. Commercial clean vehicle credit. So we talked in the individual tax section about the energy credits. So there are similar limitations that are being put in place for commercial energy credits as well as other commercial energy deductions and incentives. So first, the commercial clean vehicle credit. Under the old law, businesses could get a tax credit of up to $7,500 or up to $40,000 for larger vehicles for each qualifying clean vehicle that was placed in service, and that credit was set to expire on December 31st of 2032. But just like with the individual clean vehicle credits, this commercial clean vehicle credit will now expire on September 30th of 2025. And again, it is for a vehicle acquired after that date, and it's the same definition of acquired that we saw before, which is you have to have a binding written contract and a down payment by September 30th of 2025 in order to qualify for the credit. After that, no more credit available. The alternative fuel vehicle refueling property credit. So under the old law, there is a 30% credit for the cost of property other than buildings and structural components used to recharge electric vehicle batteries or to dispense a qualifying alternative fuel to vehicles. So this is those electric vehicle recharging stations that you see all around. Taxpayers could get a credit for that property, and that credit was set to expire for property placed in service after December 31st of 2032. Under the new law, that credit expires for property placed in service after June 30th of 2026. The energy efficient commercial buildings deduction. Under the old law, there is section 179D that allows a deduction for building owners who place in service certain energy efficient property. The deduction is the lesser of the cost of the property or the maximum savings per square foot, which is determined by a formula. Under the new law, the deduction expires for property, the construction of which begins after June 30th of 2026. Of course, the normal depreciation rules for commercial property do still apply, so they can still depreciate that property even after June 30th, 2026. The new energy efficient home credit. So this is for home builders. So under the old law, a tax credit is available for contractors who build energy efficient homes for sale to others. The credit amounts range from $500 per unit for multifamily homes, such as apartments, with a lower energy efficiency rating, up to $5,000 per single-family home with the highest energy efficiency rating. And the credit was set to expire for homes acquired after December 31st of 2032. New law says this credit expires for homes acquired after June 30th, 2026. The energy property recovery period. Under the old law, real property, including capital improvements, has a maker's recovery period of either 27.5 years for residential property or 39 years for commercial property. Certain solar, wind, geothermal, and other energy property is granted a 5-year maker's life, which significantly, of course, accelerates the allowed depreciation deductions. So if you put, for instance, solar panels on your building or other energy efficient type of equipment, normally those are capital improvements. They have to be depreciated over the life of the property, 27.5 years or 39 years. But the old law created this special 5-year life for this type of property, so you could deduct it much more quickly. What the new law does is it removes that 5-year classification, so it doesn't exist anymore. And that's for property, the construction of which begins after December 31st of 2024. So now if you put on those solar panels or whatever, you have to depreciate it over the 27.5 or 39 years. The clean hydrogen production credit. So under the old law, this was a tax credit for producers of qualified clean hydrogen. And it was based on the number of kilograms of clean hydrogen produced. The credit applies to a clean hydrogen production facility, the construction of which begins before January 1st, 2033. The new law moves that credit expiration date up to facilities with a construction date which begins before January 1st of 2028. Clean electricity production credit. So under the old law, this is a tax credit based on the quantity of qualified electricity production. It must be produced at a qualified zero-emission electricity production facility, such as wind or solar, and placed in service after December 31st, 2024, and sold to an unrelated person. The credit begins to phase out for facilities the construction of which begins after December 31st of 2032, and this credit cannot be claimed along with the next credit that we're going to talk about, which is the Clean Electricity Investment Credit for the same facility. What the new law says is that the credit does not apply to facilities the construction of which begins after July 4th of 2026 or is placed in service after December 31st of 2027. Also, if the facility construction includes any material assistance from a prohibited foreign entity, then it does not qualify if the construction begins after December 31st of 2025. And if the taxpayer is a specified foreign entity or foreign influenced entity, then the credit is terminated for tax years beginning after July 4th, 2025. So we are going to be seeing this provision about these specified foreign entities and foreign influenced entities for several of these provisions. Clean electricity investment credit. So this is a tax credit for investments in qualified electricity production and storage facilities. And as we said before, it cannot be claimed along with the previous credit, the Clean Electricity Production Credit, for the same facility. What the new law says is that the credit does not apply to wind and solar facilities, the construction of which begins after July 4th of 2026 or is placed in service after December 31st of 2027. The credit is not terminated, however, for energy storage facilities. So it is terminated for production facilities, but not storage facilities. For those production facilities, again, if the facility construction includes material assistance from a prohibited foreign entity, then it does not qualify if the construction begins after December 31st of 2025. And if the taxpayer is one of those specified foreign entities, then it is terminated for tax years beginning after July 4th, 2025. The Advanced Manufacturing Production Credit. So under the old law, this is a tax credit for United States manufacturers of eligible clean energy components, such as solar and wind, that are sold to unrelated parties. The amount of the credit depends on the component type, and the credit begins to phase out in 2030 until it is completely phased out by 2033, but the phase out does not apply under the old law to critical minerals. What the new law says is that wind energy components that are produced and sold after December 31st, 2027 are not eligible for the credit. For metallurgical coal, the credit does not apply after December 31st, 2029. The credit for other critical minerals other than metallurgical coal starts to phase out in 2031 and will be completely phased out by 2034. And again, if the taxpayer is one of those foreign entities, then the credit is terminated for tax years beginning after July 4th, 2025. The Clean Fuel Production Credit. Under the old law, this is a tax credit for the production of low-emission transportation fuels, such as biodiesel. The credit expires for fuels produced after December 31st, 2027. What the new law does here is a little bit different. Effective for fuel produced after December 31st of 2025, the credit only applies to biodiesel produced using feedstock produced or grown in North America, the United States, Mexico, or Canada. The credit in this case is actually extended to qualifying fuel produced through December 31st, 2029. So it's extending the credit by 2 years, but it is limiting it to biodiesel that is produced using the feedstock that is produced or grown in North America. And then again, if the taxpayer is one of those specified foreign entities, then the credit is terminated for tax years beginning after July 4th, 2025. Carbon oxide sequestration credit. So under the old law, this is a per metric ton credit for capturing and storing or utilizing carbon oxides, such as CO2. Eligible taxpayers, such as energy and industrial facilities, as well as carbon removal projects, can claim this credit. The facility construction must begin by January 1st of 2033 to be eligible. Under the new law, the storage and use criteria for captured CO2 have been modified. So the credit remains in place, but they have changed some of the criteria in order to take the credit. And again, if the taxpayer is one of those foreign entities, then it is terminated for tax years beginning after July 4th, 2025. Now we are moving on from the energy-related provisions into the international tax-related provisions. So first is the foreign tax credit. So under the old law, when income is subject to both foreign and U.S. tax, U.S. taxpayers can take a credit for the foreign tax that was paid. However, the amount of that credit is limited based on the amount of foreign versus U.S. income. So in general, the more foreign income you have, the larger foreign tax credit you can take. So what the new law does is a few things. First of all, it increases the deemed paid foreign tax credit from 80% to 90% for net CFC tested income, which used to be called GILTI, Global Intangible Low Taxed Income. So it's a type of intangible income. So this is a good thing for taxpayers because they're increasing this deemed paid credit from 80% to 90%. Next, the deductions that are allocable to foreign income are now limited to those directly related to that income, and companies no longer have to allocate certain interest and R&E expenses against foreign income. So under the old law, there were certain expenses that had to be allocated to foreign income, which of course then reduced the amount of foreign income when you were figuring the foreign tax credit, thereby reduced the amount of foreign tax credit the company could take. So you no longer have to allocate those expenses, which gives you higher foreign income and a higher FTC. Next, for purposes of calculating the FTC limitation, taxpayers can treat up to 50% of the income from sales of U.S. produced inventory sold outside the United States through a foreign branch of the company. They can treat that as foreign source income. So they couldn't do this before. So if they are producing a product in the United States, but then they are selling it outside the United States through a foreign branch of their company, they can include 50% of that income as foreign source income, which thereby raises foreign source income, which thereby raises their foreign tax credit. Next, and this one goes against the taxpayer in this case, when a corporation receives a distribution of previously taxed NCTI, that's that foreign intangible type of income, from a controlled foreign corporation, there is a 10% reduction on creditable foreign taxes. So if you've got this kind of intercompany transaction, when the corporation's getting a distribution from this controlled foreign corporation of this previously taxed intangible foreign income, there is now a 10% reduction in the creditable foreign taxes, which is not favorable to the taxpayer. And all of this is effective for tax years beginning after December 31st, 2025. Foreign-derived income deduction. So under the old law, U.S. corporations are allowed a deduction of 37.5% of something called foreign-derived intangible income, or FDII, and 50% of global intangible low-taxed income, that's that GILTI that we talked about before, that is included in the corporation's income. So both of these are types of intangible income from foreign sources. So these amounts, this intangible income, is already included in the corporation's income for tax purposes. We need to compute these amounts, this FDII and this GILTI, in order to determine the amount of deduction that the U.S. multinational company gets. So it's in the taxpayer's favor to have these amounts be larger because they're already included in income anyway. So making them larger isn't increasing your overall income or anything like that. We're just trying to figure out how much of our income is FDII and how much of it is GILTI income. Once we determine that, then under the old law, we get a deduction for a percentage of that, 37.5% for FDII and 50% for GILTI. So what the new law does is it makes some pretty significant changes in this area. First of all, it is lowering the deduction percentages, which obviously is not favorable to the corporation. So it's lowering those percentages to 33.34% of FDII and 40% of GILTI, except it's not called FDII or GILTI anymore. Instead, FDII is now called Foreign Derived Deduction Eligible Income, or FDEII, and the new law changes its calculation. One of those changes is that FDEII now includes sales of certain property that occur after June 16th of 2025. That's a good thing because remember, we want FDEII to be higher because we're getting a deduction for a percentage of it. So by including the sales of certain property in the formula, that's increasing FDEII, therefore it is increasing our deduction. And then as we said, GILTI is no longer called GILTI. It is now called net CFC tested income, or NCTI. Another pretty significant provision of the new law is that neither FDEII nor NCTI includes a deduction for a deemed return on qualified business asset investment, which was previously required. So under the old law, you had to look at certain tangible assets and you had to assume a certain return, a 10% return on those qualified business asset investment type of assets. And then you had to take that 10% and reduce both your FDII and GILTI at the time. So it reduced those amounts, which of course then reduced the amount of your deduction. So under the new law, you no longer have to do that. And then all of this is generally effective for tax years beginning after December 31st of 2025. Base erosion minimum tax. This is also called the base erosion and anti-abuse tax. So under the old law, this is a kind of minimum tax to prevent multinational corporations from shifting income to lower tax countries. So what these multinational companies would do is they would move their intellectual property, their intangible assets. They would move those so that the ownership was in a country with lower income tax rates. So these intangible assets would produce income. Since those intangible assets were located in this foreign country with a lower tax rate, the multinational corporation paid less income tax overall. So in order to discourage that behavior, they put into place this BEAT tax. Now, this only applies to companies with average annual gross receipts of at least $500 million and whose base erosion payments. So these are certain intangible type of payments, rents, royalties, interest, etc., that are made to foreign related parties. So if they had at least $500 million in annual gross receipts and those base erosion payments are more than 3% of their total business deductions, they were subject to this tax. The tax rate is 10% of modified taxable income, which is taxable income adding back those base erosion payments. And certain credits, such as the foreign tax credit, cannot be used to offset this BEAT tax. So if you have this BEAT tax, you can't use the FTC and certain other credits to offset it. And that rate, the 10% rate, under the old law, is scheduled to increase to 12.5% in 2026. So what the new law does is it makes the rate 10.5% permanently. So it was going to go to 12.5%. Now it's 10.5%. It also eliminates a provision in the old law that would have significantly expanded the list of tax credits that cannot be used to offset the tax. So there would have been even more credits that you could not use to offset this tax under the old law, but this eliminated that. So you've still got the same tax credits, such as the FTC, that you cannot use to offset it. They're just not going to add additional credits that you cannot use to offset it. And all of this is effective for tax years beginning after December 31st, 2025. And then our last international tax topic, and a matter of fact, our last business topic and our last topic in this entire video are other international tax reforms. So this is a few other tax reforms that I'm just going to very quickly hit on that were put into place by the OBBBA. First is the CFC look-through rule is made permanent. So this allows controlled foreign corporations to engage in certain intercompany transactions without triggering taxable income. And it is effective for tax years starting after December 31st, 2025. So if you've got these transactions that you're doing with your own controlled foreign corporations, they're saying you can do those transactions, and exactly which ones they are defined in the law. But you can do those without triggering taxable income. That had been in place, but it was set to expire, so this makes it permanent. Next, the election of a 1-month deferral in determining the taxable year of a specified foreign corporation is repealed, effective for tax years starting after November 30th, 2025. So the old law would allow you to stagger the fiscal year end of certain foreign corporations that you owned or controlled. And by staggering that year end, you could get a 1-month deferral of income. It was a tax benefit that you could get. The new law eliminates that. Next, the new law restores the pre-TCJA limitation on downward attribution rules to determine constructive ownership of foreign entities. And by doing this, they are eliminating an unintended burden on U.S. multinational companies. This is effective for tax years starting after December 31st, 2025. So when you have a U.S. multinational company, they own these foreign entities. Of course, we want them to pay tax on any income from any entity down the chain for which that U.S. multinational is receiving an economic benefit. So there are specific rules in place to determine whether or not a company falls into your chain down the line and whether or not you have to pay tax on that income. Well, prior to the TCJA, there were some limitations on those rules that prevented multinational companies from having to pay tax on foreign companies for which they really did not get any economic benefit or any significant economic benefit. The TCJA took those limitations away, and it was kind of inadvertent. What they inadvertently did was they made it so some of these U.S. companies ended up having to pay tax on income from a company that they really didn't get any economic benefit from. So the new law fixes that. It restores those pre-TCJA limitations. Next, the new law requires foreign-controlled U.S. shareholders to include in their income amounts from foreign subsidiaries, even if those subsidiaries are not controlled foreign corporations. This is effective for tax years starting after December 31st, 2025. So under the old law, in most cases, a U.S. shareholder only had to include in their income the foreign income from controlled foreign corporations. And there's a specific definition for what a CFC is. So what the new law is saying, if it is a U.S. shareholder, but they are foreign controlled, then they have to include in their amounts income from foreign subsidiaries, even if those subsidiaries do not meet the technical definition of being a CFC. And then our last provision, the new tax law changed the pro rata share rules that determine who pays tax on income from foreign entities. Under the old law, what you did is you said who owned that entity or who owned stock in that entity on the last day of the year. Anybody who owned stock on the last day of the year had to pay their pro rata portion of tax on the income from that entity. So what companies would do and shareholders would do is they would play games. So they would make sure that they did not own any of the stock on the last day of the year, and therefore they would get out of having to pay tax on that income. So what the new law says is we're going to look at ownership anytime during the year. So if you owned the stock anytime during the year, then you are going to have to pay tax on your pro rata share of the income from that entity. And that, my friends, is going to do it for our review of the OBBBA. Thank you for joining me. And if you have any questions, leave them in the comments. I will answer them if I can. And if I can't, I will let you know that as well. In the meantime, have a great day, and I will see you in the next one.